The infinity trader method is a technical approach to the markets. Our view is the markets are about people and their expectations. The price at which a stock trades represents the highest price that a buyer is willing to pay and the lowest price that a seller is willing to accept. The expectations of the buyer and the seller are what determine the price. We use the infinity trader method to determine when expectations are changing. Candlesticks. Candlesticks are the primary technical tool used for the infinity trader method. Candlesticks describe price movements of a security, such as stocks or currencies. Candlestick charts can be created in any time frame, such as daily, weekly, hourly, etc. Regardless of the time frame, the analysis is the same. A green bar is an up bar, it is a bullish bar, and it means the buyers won that bar. The body of the bar is represented by the colored in section of the bar. The open of a green bar is at the low of the body. The close is at the top of the body. The tails on the top and bottom of the body represent the lowest price and highest price traded during that session. A red bar is a down bar, it is a bearish bar, and it means the sellers won that bar. The body is represented by the colored in section of the bar. The open of a red bar is at the top of the body, and the close is at the bottom of the body. The tails represent the lowest price and the highest price traded during that session. Each bar is giving a message about what happened in that session. Questions I always ask. What is the level of penetration into the prior bar? The level of penetration into a prior bar describes how bullish or bearish the current bar is versus the prior. Did the range expand or contract? Expanding in range describes momentum is increasing. Decreasing in range describes momentum is decreasing. Are there tails on the bar? A tail on the top of a bar is an indication of selling. A tail on the bottom of a bar is an indication of buying. Retracements of less than 50% suggest continuation of the prior move. Here we have a green bar that closes very strong. It's followed by a red bar that's penetrating only about 20 to 30% into the prior green bar. This is bullish price action and suggests prices will continue in the original direction. In the next example, there is another bullish green bar that closes right at its high. The next bar penetrates approximately 50% into the prior green bar. This is still bullish price action and suggests continuation of the original move. Here is another bullish bar that closes strong. It is followed by a complete reversal on the very next bar. This is a bearish price action and suggests continuation of the reversal. In the next example, we have a bearish bar that closes very weak. It's followed by a bar that penetrates only about 20 to 30% into the prior red bar. This is bearish retracement and suggests continuation of the original move. In the next example, there is a red bar that closes right at its low. It's followed by a bar that penetrates about 50% into the prior bar. This is bearish price action and suggests continuation of the prior move. In the final example, we have another red bar that closes right at its low, and it's followed by a complete 100% reversal. This is bullish price action, and it suggests continuation of the reversal. A narrow range bar is a low momentum bar. A wide range bar is an increase in momentum and commitment from the traders who created the wide range bar. Expanding in range from a period of low momentum suggests continuation in the direction of the expansion. Expanding in range after a multi-bar move increases the odds for a reversal of momentum. Okay, so here we'll look at a real example of the Qs. This is a 2-minute time frame from August 10th. And what we're just looking for and looking at is how the range expands as prices continue to move down. And as prices expand in range, it increases the odds for a reversal. So this here did not really reverse the trend of the move, but you can see how the biggest bar is after several down bars, and that did set up a pause in the market before it did continue lower. There was no reversal, but it did set up a pause. Again, once the market starts dropping again, notice how the range of each bar begins to expand as it drops. This increases the odds for reversal. And then the biggest bars of the entire move are right at the low, especially the one right at the low. It's one of the biggest red bars of the entire move since it began. That's showing us exhaustion, that everybody is becoming in agreement that prices are going to go down, and the markets are a supply and demand driven game. So once everybody is in, the only thing that can happen is for prices to reverse. So continuing is some other minor examples. Here you can see another one where prices dropped and the range expanded, and as prices expanded, it set up the reversal. And same thing on the upside. You can see, look at the size of all the bars, and then the biggest bars of the entire move are the bars right at the end of the move. Just scroll back and look for a few other great examples here. And again, you can even see this whole move here. Prices didn't have that expansion one bar after the other, but notice how the biggest bars of the entire move happen right at the end of the move. And same thing on this move down here. It started with the wide range bar that ignited prices. So a wide range bar from a period of narrow range bars is igniting prices in the direction of the wide range bar. But then notice the biggest bar of them all, it's not right at the low, but it's right near the low. So a range expansion in the beginning suggests continuation. A range expansion at the end or after a multi-bar move suggests an increase of odds for reversal. All right, we can take a look at the diamonds for a couple of minor examples of the same thing, and we'll do it on a 5-minute time frame. So you can see this here, the range expanded right at the end, but it did continue going a little bit. But again, look at the biggest bar, one of the biggest bars of the whole move. It didn't set up reversal, but it did set up more sideways consolidation. And this here, look at the move. Wide range bar igniting from a period of narrow range bars, ignited prices, and then we have the two biggest bars of the move right at the highs. Here's a big giant bar and a big giant bar right after a multi-bar move. Okay, so we'll continue to move it along. As price decreases in range, it shows there is a loss of control one side has over the other. Price consolidating or moving sideways shows an equilibrium between buyers and sellers. Okay, let's look at some examples. This is the spiders on a 1-minute time frame. About 12:45 on 8/12/2020. So here we have the range contracting, prices ignited lower with a wide range bar that started the move, a very potent bar. and prices just contracted in range, showing us as they came down into this area here, the sellers lost control. You can see they started with strong control, and then there became more of an equilibrium between the buyers and sellers. The sellers, did not have complete control in this area. There was confusion and more of an equilibrium. Again, prices expanded in range, but then they decreased in range, just showing that in this area, the buyers have, lost control relative to the control that they had on the move higher. So another one here, you can see how prices started out with the range expansions in the beginning, and then the range contracted, showing us that the sellers are losing control as this move went lower. It doesn't mean it sets up a reversal. I'm just pointing out that we want to understand that as the range of the bars contracts, as prices decline, the sellers are losing control that they had relative to the past. When momentum increases, the traders who created the momentum have an expectation. Always ask, how is the current bar affecting the expectations of traders in the last bar? Breakout. When price breaks out from a consolidation, it shows there is an increase in traders committing to that bar, and they have expectations of price continuing in their direction. Breakout failure. When price comes back through the breakout point, it traps those traders in losing positions and can lead to them exiting, fueling the reversal. So let's have a look at some breakout failures and breakdown failures. So here's one. This is the spiders. You can see we have this little consolidation here, sideways bars, and then you get a wide range bar taking out the lows of the consolidation. It's then followed by a complete 180 reversal. So this is a breakdown failure. This bar was a breakdown when it took out the lows of this consolidation of these bars, and then it was completely reversed on the next bar. So there is a breakdown failure. That's a very nice reversal. Here's a breakout failure right at the top. We have a little 2-bar consolidation. Prices have rallied up. Then a little 2-bar consolidation, and then the range expansion, this big strong bar, breaking out to new highs, followed by a complete reversal. So this is a breakout failure. The traders who had expectations of this move continuing higher, their expectations were negated on the next bar, and when this potent bar reversed in price, trapping all those traders from the previous bar. Here's another breakout failure right at the high. Get this consolidation here, sideways price action, equal highs of all these bars. Wide range bar breaking out not only above these highs, but also to a new high of the day. It's a very powerful bar suggesting prices should continue higher, and the traders who create this bar have an expectation prices will continue. Prices then failed when they came back through the breakout point, back to this point. So right over here, this is a failure, trapping all the traders and their expectations who created this bar. Let's try a few on the Qs. Here's the same, a nice breakout failure, sideways consolidation, wide range breakout bar, getting slammed coming right back through. So there's a nice breakout failure there. Here's actually a breakdown failure that only paused prices, and prices did continue, but you got the extended move down and then the consolidation with a breakdown and 180 reversal. So this shows they don't always work out. Nothing ever does. But it is a very consistent pattern that pops up in the markets, and so one to take notice of. Here's a breakout failure right at the highs. This big wide range breakout bar breaking out from this sideways consolidation and getting slammed right back down again. Here's a breakdown failure, this sideways consolidation with this wide range breakdown bar followed by the inside bar, and prices come back through the breakdown point. Here's a nice breakdown failure reversal. Here's a little sideways consolidation after a move down, and then we get this range expansion that wound up being a bottoming tail, and then followed by a strong reversal, and then the next bar taking out the high of the breakdown point. So a nice breakdown failure right in here. Here's a nice breakout failure right up here. So we got the extended move to the upside. We have the widest range bar of the entire move. We have sideways consolidation, range expansion breaking out from that consolidation, followed by an inside bar with complete reversal coming back to the breakout point, setting up the breakout failure. All right, move it along. Topping tail and bottoming tail bars show us a complete reversal of momentum in that session. Think about what effect the reversal and momentum has on traders' expectation. So in the first example, all three of these bars have tails on the top of the bar. So during the session of these bars before they were closed, these bars were all strong green bars at one point. There were traders who created that green bar because of their buying. Those traders had expectations prices would continue in their direction. But by the time that bar closed, each of these bars closed, prices had sold off and came right down near the low of the bar, trapping any of the traders that purchased long in this bar in a losing position. So these bars can be powerful to set up reversals because of the failed expectations of the traders within the bar. So a spinning top at one of these bars with tails on both the top and bottom, what this bar shows us is complete confusion, but it also shows us that there's something different that's happened versus anything that's happened in the prior bars. In this example, we have a green bar that starts out very strong and the buyers have complete control. The buyers have control in the next bar. The bars are reducing in size, so the buyers are losing a bit of their control, but they clearly still have control. Then by the time we hit the spinning top bar, this bar shows us that there is erratic behavior. This bar was first a green bar, like all the prior, and then it sold off and was a red bar. And then it came back to close even with its opening price to create this little dash. So there's a lot of confusion that's happening in this bar. There's disagreement that's happening within this bar. And that's something different that's happened in any of the prior bars before it. And the same thing on the downside, you've got complete agreement going down. There is a loss of control. However, there is still complete agreement with the red bars. And then we have this completely erratic bar, erratic behavior where there's a loss of control and nobody has complete control. So that is a message that's telling us something has changed versus all the prior bars. And then bottoming tails show us the exact opposite of what the topping tails did, is that these bars were all red bars at one time because of sellers and short sellers, and they have expectations that prices would continue lower. So if you enter a short position on one of these bars, and then the bar closes up near its high, you are now in a losing position. And so that can lead to you exiting your position, and in order to exit a short position, you have to buy. So your buying can fuel the reversal of these bars. So let's look at some examples of bottoming tails. So here, right off the bat, we've got a few topping tails right at the high. You can see how prices move up, and then you got some topping tails. Now it didn't set up a complete reversal or anything, but it certainly did cause prices to consolidate and go sideways for a little bit. Nice topping tail bar right here. They took out the prior high, so we got prices move up and then in a topping tail. This is showing us distribution. This is showing us that in this area there's a big seller. Right. Anyway, you can see quite often at the lows and bottoms, there's bottoming tails. Right before this big move, we got these tails. Those bottoming tails are an indication of buyers, of a big buyer down here. The same thing here, these tails that are over here. So tails are showing us if there's a bottoming tail, it's showing us that there's accumulation, and if there are topping tails, it's showing us distribution. So here is the spinning top bar. You can see this nasty red move down. And then there is this erratic, crazy bar. It did not set the low, but it did happen in the area of the low after this extended move down. And just you can see all the topping tails at the highs and at the lows. And the bigger the bars, the better. You know, some of these bars are small with tails. Ideally, you want to see that the tail is 2 times the size of the body. And the bigger the bar, the better. Bars with small little bottoming tails or, you know, topping tails, we take notice of, but the bigger they are, the bigger the range of the bar is, the more powerful of a message it is. So let's move it along. Close at high. A bar that closes at its high describes complete agreement within that bar. Traders expect momentum to continue in their direction. Close at low. A bar that closes at its low describes complete agreement within that bar. Traders expect momentum to continue in their direction. If there is no follow-through on the next bar after closing at the high or low, it's common to see price reverse with momentum. All right, so it's very common to see a bar that closes at its high or low. If it closes at its high, it's common to see those bars ignite prices to the upside. If a bar closes at its low, it's common to see those bars ignite prices to the downside. If prices have no follow through, so if you have a bar that closes at its high and then there's no follow through on the next bar or the next 2 bars, it's common to see prices reverse and sell off. And same is true to the upside. If you have a bar that closes right at its low, if it does not move lower on the next bar or next couple of bars, it's common to see momentum reverse to the upside and buying come in. So looking just right here, this is the Qs 727, and this is a 5-minute chart. You can see this bar that closes right at its high. This bar looked very bullish, breaking out of this consolidation, sideways price action. This suggested higher prices. And then there was a completely reversal on the next bar. That's what set up for prices to sell off after that happened. This bar here closed right at its high, the most bullish bar of the whole move. You didn't have another bar close at its high on the whole move. And ultimately prices did go higher, but just notice how after that bar closed, it caused prices to stall when they didn't continue higher. And then this bar did not happen at the high, but it was very close to the high. So again, bar closes right at its low here. Now again, this did not set up a reversal, but it did cause prices to go sideways for an extended period of time. Now the bar that closed right at its low, prices should continue after this, and they don't. It sets up, in this case, it only set up a sideways consolidation sideways before ultimately it did go lower, but it didn't have any follow through to it. You can see this inside bar closed right at its low, and there's follow through. Bar closes right at its low, and there's follow through. Right here, bar closes right at its low, and it sets up the reversal for prices to move higher. And then this bar closes right at its high. It didn't set the high, but you can see the consolidation that happened after it. This bar here closed right at its high, didn't follow through, and set up a reversal. This bar closes right at its low, prices follow through. See, it's very common to see these bars that close at their highs or low at the very beginning of a new move. Bar closes right at its high after an extended move to the upside, has no follow through, sets up the reversal. Okay. Below are the most potent candlestick combinations we will use to build the Infinity Trader method. Retracements of less than 50% into the prior bar suggest continuation of the prior move. Retracements of greater than 50% into the prior bar suggest continuation of the reversal. Wide range bar expanding in range is an increase in momentum. Range expansions from a period of narrow range bars suggest continuation of momentum. Range expansions after a multi-bar move in one direction suggest reversal of momentum is near. Tails show us a reversal of momentum in that session. A reversal of momentum can ignite prices in the direction of the reversal. Support and resistance. Support and resistance are areas where other traders will take action. Key points. Support or resistance are represented by pivot lows, pivot highs, unfilled gaps, and consolidations. Price void is described by areas where there are no references of support or resistance. Once price has successfully moved through support, it becomes resistance. Once price has successfully moved through resistance, it becomes support. Once price successfully moves through resistance, it becomes support. Support or resistance is removed once price moves above and below that area. Pivots are price levels where momentum reversed. Once a pivot has formed, an area of support or resistance is formed. A major pivot high has at least two lower high bars on both sides of the high bar. A minor pivot high has two lower high bars on the left side and one lower high bar on the right side. A major pivot low has two higher low bars on both sides of the low bar. A minor pivot low has two higher low bars on the left side and one higher low bar on the right side. So here are a lot of examples of major pivot highs and lows and minor pivot highs and lows. And really what we're looking for are just the turning points. You know, the rules of having two lower high bars on each side and so forth, they're just general guidelines. Sometimes a clear pivot can form and it doesn't meet the exact definition. That's not really important. What is important is that we recognize the major turning points. And when they are these major turning points like these examples here, or like the major pivot lows, these major pivot turning points, these are what we would call major pivot lows, are these big turning points. A minor pivot low would be the examples here where we have this strong rally and we have just these little small pullbacks and then they take right off. These would be minor pivot lows and also minor pivot highs in this example as well. Just a few bars and so they take right off. So on the rest of the chart, you can just take a look at all the different minor pivot highs and minor pivot lows, major pivots, and take a look at what we're looking for, the type of turning points here that we're talking about. So each of these turning points are just minor pivot or major pivots. Consolidations are price points where momentum stopped and an equilibrium between buyers and sellers extends for a period of time. When price breaks above a consolidation, it becomes support when price pulls back to it in the future. When price breaks below a consolidation, it becomes resistance when price rallies to it in the future. Let's look at some real-time examples. So this is the Dow Jones Industrial Average on a 15-minute time frame, July 7th, 2020. And look at this move here, how prices, there's this consolidation and prices break above the consolidation. Now they pull back to it and they stop right at the top of the consolidation. Whereas once you break through the ceiling, it becomes the floor. Once you break through resistance, it becomes support. Prices again create an area of resistance with these highs here. Prices break above it and they pull back right to it. So right to the top of support. And then prices consolidate again in here, prices break above it, and they pull back right to it. And this is the area that acts now as support. What was resistance is now support. Again, we gap up, and this time prices consolidate. And if you notice on this rally higher, each time the market rallied, it stayed above support strong in a strong manner. Each time it rallied, prices did not penetrate below any areas of support. Then finally, after this consolidation here, prices break below the consolidation for the first time. And now they consolidate right under the consolidation because what was support is now resistance. You can see how this consolidation is forming just under the lows of the prior consolidation. So this is a bearish price action, which is something that you can't see prior to this move. On all these other rallies and declines, prices remained above the area of support. So this is the first key area telling us that there is a reversal of trend. Then prices consolidate, they break below the consolidation, so they break below the support. Prices rally back to the support, which now becomes resistance, and that's where the sellers are again. Prices consolidate in this area, creating an area of support, and they break below. Now this time prices do make it through it, but you can still see the reaction. As prices rallied, they reacted right to the bottom of the resistance and penetrated into it. It took a battle to get through this area of resistance. And you can see that by the whippy price action in that area before finally accelerating through. So let's look at some more good examples. Here you can see sideways consolidation. Prices broke below the consolidation, then they rallied back to the consolidation and found sellers right at the bottom of the resistance. This whole rally, you can see how prices break above the consolidation, then they pull back, and this consolidation is moving sideways on top of the previous consolidation, right? It's now acting as support. We can take a look at a few examples on the cues. So we'll do it on a 5-minute time frame. Again, you can see this consolidation here. Prices break above, and then look where this consolidation happens. It happens right on the tops of this prior consolidation. So what was the ceiling is now the floor. Prices break above, and just notice how each time they break above resistance, it becomes support. This consolidation here, this was a pivot low. Prices broke below it. Then look at the rally right to it. Comes right back to the pivot low. Consolidation here. Prices broke above the consolidation, and then look at the sell-off happens, and it comes right to the top of the consolidation. So this is now an area of support once it was broken above. On this move lower, here we have pivot lows. Prices break below a pivot low here. They rally back. They can't make a new high. This looks like a breakout failure or a wide range bar followed by the inside bar, getting slammed back down. Now price is clearly break below this pivot low, and then they rally right back to the pivot low. So they find sellers right where the buyers once were. And prices drop again, taking out a pivot low. They rally. They don't even make it quite back to the pivot low area. The sellers came in aggressively here on this rally to the upside. If you look at the rally, we got this little consolidation right here. Little consolidation right here. Prices break above. Now they pull back and they find support right at the consolidation. Prices break above. They initially tried to hold a support and it failed. Again, this rally, you can see the consolidation. Prices broke above, they pulled back, and they found support right at the top of the consolidation, which ultimately failed. But you can see the buyers, how they came in right at that area. Here, this consolidation up here, prices clearly and decisively break below it. Now they rally back to it, and that's where the sellers are to drive prices lower. Here, prices broke above this consolidation. Now prices pull back to the consolidation, and this is now an area of support. Okay, so let's move it along. V pivots are described by fluid pivots that leave no consolidations. V pivots have less support or resistance for price to move through that area in the future. Visually measure the amount of support versus resistance to help determine the odds of future price moves. Price moves in the direction of least resistance. So let's have a look at some examples. So here we can see prices break above this consolidation over here. Prices break above the consolidation. Now they're consolidating sideways. If we look to our left and measure, look at how big this area of support is. And if we're looking above us, now when we've pulled back down to this point here, this is a V pivot high that's up here. This type of a pivot does not leave a lot of resistance so that prices can easily move through that area in the future. So as prices are down here, if you visually look at how much resistance there is just based on the number of bars, the size of the consolidation, versus the support area that you are at, which we are at a big area of support, the odds are overwhelming here that prices would move higher because the market is going to move in the direction of least resistance, and there is less resistance on the upside than there is support on the downside. And again, here we have this sideways, this big consolidation up top. Prices now break decisively below that consolidation and then they rally. This V pivot low does not leave a lot of consolidation. It does not leave a lot of support. So when prices rally up and form these topping tails and potent reversals here, if you visually measure at this point the amount of resistance from this area versus the amount of support provided from this V pivot low, there's no comparison. The odds are overwhelming that in this case the market would decline given the amount of overhead resistance versus the amount of support below. And same thing with this little move here. As prices break above the consolidation and you get this powerful, we got a range expansion bottoming tail with a powerful wide range bar here. At this point, if you're looking to our left just to these points and how much resistance there is above here versus the amount of consolidation, the odds are overwhelming again that the market would move higher, even though it only went a little bit higher. It didn't go much higher, but when you're at this bar, the odds are overwhelming. The market would continue higher based on the amount of resistance versus support. And again, even this move here, if we take a look, now this little move here does create some resistance on the way down. It creates this consolidation. So as prices are down here, but look at the size of the support area. This is a big base that we have, and this is a V pivot, and it's a wide range bar, after prices are already, there's a lot of wide range bars here, but this is another wide range bar after prices are already extended to the downside. So the extended move to the downside, the wide range bars, the potent reversal, the information here does suggest the market would move higher. I couldn't predict it move this much higher, but it does suggest when you're down here, given the support level here versus the amount of resistance above, that the market would push higher into these resistance points. Again, nice little example here. Get a sideways consolidation. Prices break above the consolidation, then they pull back to it. So at this point, when we're at this green bar here, looking at the size of the consolidation versus the amount of resistance above in the consolidation above, the V pivot does not have as much resistance as this consolidation of support has. So the odds are the market would advance higher. All right, so that's some examples of that. A gap occurs when a stock opens above or below the previous bar's close with no trading activity in between. A gap fill occurs when a stock price overlaps with the closing price of the bar prior to the gap. Okay, let's take a look at some examples of gaps. We'll use the Qs on a 5-minute time frame. And you can see here was a gap. So this bar closed on this day, and then the market had gapped up. And so now you see there was initially a rally, but prices sold off. And when they did, they came back into the gap fill area, and that's where the buyers were. This is where the buyers came in aggressively, is right at the gap fill area. This tail looks like it's a fake tail, but you can see how it reacted right to the gap fill. Even over here, when prices rallied up, the gap becomes an area of support. Prices pull back, and they found support right at the gap fill. Here is a gap down in the market. You can see the rally, but then this rally here, it went up and it found resistance for the short term right at the gap fill. Actually, that was even a little bit low, but even in the future, again, the gap fill area continued to act as resistance until it was completely removed. So another gap. Here's the market closing on one day, gapping up the next day. Prices pull back and they find support right at the gap. The same thing later in the day. Prices pull back and the gap fill is acting as an area of support for the market to then rally from. And here's a gap down where the market really didn't react to the gap. They don't every time. Prices, finally rally, and you can see very little reaction this time to the gap. Little tail, little consolidation after filling the gap, but prices do continue. Another gap, prices gap down, the rally finds resistance right at the gap. Finds resistance right at the gap. Okay. And lastly, you can see when the market is very aggressive, here we have another gap up, prices rally, and then they drop. Now they didn't even make it to the gap fill this time. The market was very strong, so it found the buyers right on top of minor support, right on top of the support from this previous pivot high area. But this whole area, you can see how it once again acted as support. What was the ceiling is now the floor. When price moves through an area of resistance, that area becomes support. What was the floor is now the ceiling. When price moves through an area of support, that area becomes resistance. Okay, let's look at some examples. So this is the Qs on a 5-minute time frame, and looking at this move right here. We'll start with this. You see prices rally, they form this little consolidation. Prices now break above the consolidation, so what was resistance becomes the floor. Prices now pull back to it, and now that area acts as support. So what was the ceiling becomes the floor. Again, this consolidation, prices decisively break above it, and then the rally, the decline, you can see finds support right at the top of the resistance area that was resistance is now support. Here in this example, prices gap below this area of consolidation, and then prices rally back to it and find resistance right at the area that was support in the past. In this move down here, you can see this sideways consolidation. What was support, prices break below the support. Now prices rally back to it, and now that area is an area of resistance. So what was the floor becomes the ceiling. Here you can see prices break above this sideways consolidation. That was an area of resistance, and now you can see it clearly acting as an area of support. This whole little move here, if you watch it, if you look closely, is a little consolidation here. Prices break above, then they pull back to it, and they act as support. Consolidation here, prices break above it, then it pulls back to it, and now it's support. Prices break above it. You can see just a little bottoming tail here happening right on top of the previous highs. And just continues. Prices break above, they pull back right to support. Look at a few examples on the diamonds. Or we can look at a few examples on Apple Computer. All right, Apple Computer. Here you can see this is Apple Computer, July 10th, 2020, approximate date. You can see consolidation, right? What was the ceiling, prices break above, now becomes the floor. Prices break above, and then that area acts as the floor. Prices break above resistance, now that area acts as the floor. Just continues to happen over and over again. And this is a beautiful trend. As prices break through areas of resistance and just pull back beautifully, now they become support, just stair-stepping its way up. Each time it breaks above resistance, that area becomes support, the whole rally. And then finally here now, prices extended away from support, but now they've dropped and penetrated right through an area of support for the first time on that whole rally. So clearly something is different here. Okay, we can take a look at Facebook. Here, this is the most recent price action. It's 223 on 820. But you can see how this whole consolidation, prices right now on Facebook are breaking out. This whole sideways consolidation, prices broke above it. Now prices pull back right to it. Now they're breaking out above it again. So that area, whole area, once broken above, became support for it to rally from right now. This area of resistance, prices broke below this. This was support. As prices broke below it, look at as the rally comes up, the rally stops right at what was support, now becomes the ceiling. Prices drove it down. You can see here again, consolidation, prices react one to the gap and the consolidation, but prices pull back again and react to the gap and the consolidation. What was the ceiling becomes the floor. All right, so let's move it along. Support or resistance is removed once price moves above and below that area. So here in this example, as prices form this pivot high, pull back, then rally and take out the pivot high, this area now becomes an area of support as prices pull back to it. Once prices trade below this area to our left, this area is no longer an area of support. It is now currently an area of resistance. As prices rally, you can see they react to the resistance. Once prices move through that resistance area, this is no longer an area of resistance. So at this point, we no longer have to focus on this area as an area of support or resistance at any point in the future. The only areas that we are focused on as support or resistance are the areas to our immediate left. What is to our immediate left? And that's it. The price action that has not been traded above or below. So currently this was resistance, but now it's been traded above. It is now removed as resistance. So at this point, the only resistance point there is to focus on is this pivot high, which is a V pivot. And the areas of support to focus on would be this minor pivot high and also the major pivot low. Now as prices pull back to the minor pivot low, prices then rally from that point. At this point here, the only area of resistance we really have to focus on is the current pivot high, which did take out the previous pivot high. So this point is an area we really don't have to focus on anymore. We are now just focused on this current pivot high here. Prices rally and they move through it. So now this is removed as an area of resistance. We will never again in the future look at this area as resistance. It is currently support. As prices pull back to it, it is support. But if they move back through, this area is now no longer support or resistance. So from this point, the only areas of support or resistance I'm focused on is there is resistance here at the minor pivot low, there is resistance here at the major pivot, and there is resistance here at the major pivot. There is support at this pivot low and support at this pivot low. Everything else on the chart has been traded above or below, so we no longer pay attention to those areas. Okay, let's look at some examples of support or resistance being removed. So we have prices that break up, they're breaking out here, prices are rallying, and here's a pivot low. Finally, prices break below this pivot low. So it removes this area now as support. So when prices are over here and they've come down and taken out this pivot low, this area is now no longer support. It's now become an area of resistance in the future. But from here, we would look to the next areas of support as this consolidation here, these little pivot lows, the unfilled gap, the top and the bottom of the unfilled gap, and the major pivot low. So all these points are our points of support. So once we get below this, the next thing I'd look at is, you got a little minor thing here, but the gap fill and then the bottom of the gap fill. So as prices drop, you can see they drop right to support. Now they've created these areas of resistance above. It has resistance here, it has resistance right here, and it has resistance at the pivot low as prices are over here. They rally and they penetrate this area first. At each time they penetrate, they weaken the area as an area of resistance. So prices rally, they penetrate this area, weakening it as resistance. Prices pull back and they form these range expansion bottoming tails, potent reversals, and now prices rally again. They can now push deeper, higher up into the area of resistance because it was penetrated once in the past, weakening that area. So prices rally, although it's still resistance, and we have resistance here and then resistance here. Prices rally again, penetrating and weakening these areas, but they're still the resistance points. Prices break below support, and then prices rally up to penetrate that resistance. It weakens that area and it forms this V pivot high. So as prices are down here on this wide range bar, the only areas of resistance that you should be focused on right now is this current V pivot high. These two pivot lows have been penetrated, so I'm no longer focused on these areas. I'm now just focused on the V pivot high when you're down here. So the V pivot high, and then the next areas of resistance would be this little minor pivot here, and then this pivot high, and this pivot high. Nothing else to the left would we focus on because all this stuff has been traded above and below. So it's only what is to your immediate left that we want to focus on. So prices rally and they penetrate into the area of resistance, weakening the area of resistance. Prices pull back, they create another V pivot high, and then prices rally, penetrating again into the area of resistance. On this move here, as prices break above the consolidation, then pull back into it, it's now an area of support. There's a V pivot high that's formed. Prices, you can see, go up and react to the V pivot high, but look at the price action that happens. We have a bullish 180 reversal right here, a range expansion bottoming tail right here. This price action is telling us that it is absorbing the supply coming in from this area, and there's not a lot because this is a V pivot high. However, the price action, the bullish price action, is showing us that the sellers are coming in, but the buyers are aggressively scooping up that supply that's coming in. and prices finally move through the area of resistance. So this is now no longer resistance at any point in the future. All right, here's a good example. This sideways consolidation, prices break below the consolidation, and now this area is an area of resistance. So you can see prices rally to it with this wide range bar, but there wind up being tails and whippy price action in this area. But this is penetrating the area of resistance. So it's weakening this area as an area of resistance. Prices drop. Then they give this nice pattern. Prices rally back up. See the V pivot high that's in here? V pivot high that's there, prices rally back right to the V pivot high, penetrating the current area of resistance created by this right here. Create another V pivot high because it penetrated this area and weakened it. So now making it so that in the future over here, it can move through that area easier in the future. Prices rally again, penetrating it more, but still reacting to it. And prices pull back and then ultimately get through it. They continue to react to the areas of resistance, penetrating and weakening those areas. But as they move through them, they're no longer resistance at any point in the future. All right, so here we'll go over this one last example. Here we have, so prices create an area of resistance right here. Prices sell off and they leave this consolidation above, so that's an area of resistance. Prices rally, penetrate their area of resistance, weakening it, sell off. Prices rally, penetrating it and weakening it again. Don't move it all the way through it, so it is still resistance until price moves all the way through it. But each of the penetrations are weakening that area. Prices pull back and rally again. Now prices have completely moved through this entire area. So once we get up completely through it with, see these bars right up over in here, this is where this area is no longer an area of resistance, so we would never focus on it as resistance in the future. We are only focused on what's to our immediate left. Even as support, when prices are up here pulling back, I am more focused on the area of support as you look at it here. This is more important to me than what this is over here as an area of support, even though this area is now traded above, so it is support, but I care more about to the immediate left. This is more important right here than this is over here. However, take note that this is support and so is this. Prices, look at all this whippy price action up in here, these consolidation of bars. Prices break below it, it's now resistance. Prices rally up and penetrate the resistance, then sell off. This creates a V pivot high. So as prices come down here and form this little bottoming tail, for it to move back through this area now in the future is easier because this move penetrated and weakened the area of resistance coming in from this price level. So prices can move through it easier in the future, removing it as resistance. As prices rally right up through, it removes all of this as resistance. We never look at it as resistance in the future. So as prices are over here, I don't look at this area over here as resistance anymore. The only thing that I'm looking at as resistance when we are over here would be the immediate consolidations above and any pivot lows that have not been traded above and below. Okay. Price void is described by areas of fluid price movement that leave no references of support or resistance. In the future, if price moves into an area of price void, there is no support or resistance to reverse the current move. Okay, so let's look at some price void examples. This is the Qs. So we have this is an extended move to the upside. This move here really didn't create a lot of support. There is some consolidation in here, but it's all minor. It's minor consolidations, minor pivot highs, so it's not a whole lot of support. As prices drop, these areas of fluid movement, when you have these big bars, especially this one here on this chart, this is the best example here. This is clean price void. There are no references of support or resistance in this area. So in the future, when we are taking positions looking to our left, this is the type price action that ideally you'd see to your left is something that doesn't give you any references of support or resistance. That means the market has the greatest chances of moving the furthest for you with your position. So areas of fast, fluid price movement are areas of price void. And when they are created, in the future, price can move through those areas faster than areas of consolidation. And if you look at this move down was followed by a sharp move right back up. It was able to bounce right back up because there was no resistance created on the move. It bounced up until it hit the resistance. But then even look at the way the move rallied. It rallied fast and sharp, and that's why the move dropped fast and sharp. We have this wide range bar starting, and that's because this is a V pivot low with a fluid move up. And if we go to our left looking at support, there's nothing but really price void over here too. Little consolidation right there, but not a lot. That's what enabled this move to drop fast through this area until it hit the real support at the pivot lows. This is another little area of price void in here. Price has never pulled through it in the future, but just to point out what price void is. Price void is going to be those areas like this here where there is no consolidations. This would be an area of price void. Same thing in here, this move down. This is an area of price void in here. The consolidation is here. Now look at this example. This is a great one. Here we have this move down. That's a fluid move, little sideways consolidation. Break down again, it's a fluid move. Prices now rally, and they rally right, and they rally pretty quickly. Wide range bar, range expansion bottoming tail, wide range bar, very quick moves right up to the area of resistance. Then prices do this breakdown failure. Here's a consolidation, here's a breakdown bar right into an area of support, and followed by the inside bar, prices come back to the breakout point. But look at how fast this move is able to happen now. And it's able to happen this fast through here because of the price void created here. Prices did come up, and look at the small consolidation. The narrow range bars happened because of the resistance created here. The fastest move happened, if you look, once we took out this pivot high, once we went through this area, that's where the fastest move happened, was right in the area of price void. Same thing here, gaps. Gaps by definition are price void because there is nothing that we visually see in our way. So here you can see the fast move down, and the reason the fast move down happened is because there were no references of consolidation, no references of support. So price void, this area of price void is what enabled the market to drop. And then look at the sharp rally back up. The sharp rally happened back up because of the fast fluid move down. So fast fluid moves do not create lots of support or resistance, and that's where you can get the sharpest moves. Here's another example. Prices have this fast, sharp, accelerated move up, and then look at how fast and sharp the move down is. And that's because this quick move did not create any areas of support. Same thing here, price void, this fast, sharp move down creates an area of price void. It snaps right back up with no resistance and just shoots right back up because nothing was created on the way down. Okay, so moving along. Support or resistance are areas where other traders will take action. Key points. Support or resistance are represented by pivot lows, pivot highs, unfilled gaps, and consolidations. Once price has successfully moved through support, it becomes resistance. Once price has successfully moved through resistance, it becomes support. Support or resistance is removed once price moves above and below that area. Trend. A trend is the overall direction of a market or a stock's price. Guidelines. There are three types of trends: up, down, and sideways. Uptrends are characterized by prices making higher pivot highs and higher pivot lows. Downtrends are characterized by prices making lower pivot highs and lower pivot lows. Sideways trends are characterized by prices making equal pivot highs and equal pivot lows. The level of retracement against a trend describes its strength or weakness. Trends move in wave patterns of typically 3 to 5 before a trend is extended. An uptrend is formed when two higher pivot highs and two lower pivot highs have been created. The uptrend continues for as long as price is making higher highs and higher lows. A sideways trend is formed when two equal high pivots and two equal low pivots have been created. The sideways trend continues for as long as price is making equal highs and equal lows. A downtrend is formed when two lower high pivots and two lower low pivots have been created. The downtrend continues for as long as price is making lower highs and lower lows. All right, so let's look at an example of an uptrend here. So to start on to the left here, this is a 2-minute time frame of the Qs. Prices have a strong rally. They pull back and form some pivot lows and then break out again. So, and then pull back once again. Now at this point, once you have these two bars here formed at this point here, this is at the point where it's clearly an uptrend, because there are now is an equal high, there's a higher high here, so high point, higher high, and you have a low point, and then you have a higher low. So two higher highs and two lower lows to equal the uptrend. Prices rally and then they pull back. There is a series of little pivots in here that have lower highs and lower lows. So this is a mini downtrend. It is a downtrend on a smaller time frame, but really this is still where the pullback, if we look at retracements, the level of retracement against the move, this is still a bullish retracement. So even though there is this little mini downtrend within this overall bigger bullish picture, I would never consider shorting any of these moves or anything like this, because clearly the bigger picture is the uptrend. So this should really be looked at as a pullback in an uptrend, and then finally when prices rally up and take out these prior pivot highs, this is clearly showing the next higher high. So now you have a low point, higher low, and you have a high point, higher high, prices advance. They keep pulling back and making higher lows. Each time it rallies and declines, it makes higher highs and higher lows. So the trend continues. Here the trend got whippy, but everything remained intact, never overtaking a major pivot low. So the uptrend continues. Prices rally. Finally, at this point, this is the first point where they really overcome a pivot low. So this is the first negative point. Prices finally overcome a pivot low. Prices rally. They fail to make a higher high, so they make a lower high. So this is now a downtrend. Once we have this red bar here, this has now started a small downtrend, again within this bigger uptrend. But this is a downtrend at this point. The downtrend continues until it drops down into this point, till it comes into the support, and then prices explode higher. Once prices overcome the first area of resistance here, the downtrend is over. So this move stops the downtrend, and then prices consolidate up here, now forming what looks to be like a sideways trend is forming. As prices continue, you can clearly see this is a sideways trend here. And then prices break out above the sideways trend, and then they pull right back to it, creating a V pivot high, pull back right to the sideways trend, the top of it now acting as support, and prices continue higher to form a new uptrend. And prices, here's another downtrend. You got prices at lower highs. This is really extended stuff. But once we take out this low over here, this is confirmation of where it's a downtrend. But prices drop right into support, then they rally up, they come down. Now as soon as this move here happens and it overtakes the first area of resistance, the downtrend is over. So currently this is really looking like the formation of a sideways trend, some whippy price action that's happening in here right now. So let's have a look at another example. Here is a clear uptrend again. So here, let's start with the gap. We'll look back a little further. We'll follow along here. Starting here, we had this gap up, strong gap up on this day. Prices, this is a sideways trend here. Prices making equal highs and equal lows. Prices finally break out of the consolidation, and then prices consolidate again with a little mini sideways trend, and they consolidate again on top of the prior support or prior resistance, which is now support. But it's now formed an uptrend. We have higher lows and we have higher highs. So this is clearly an uptrend. Prices break again, forming a higher high relative to its past. And so the trend continues as long as prices are making higher lows and higher highs. Finally, prices accelerate from support and prices come selling off. They rally and sell off again. Then rally and sell off again. Now, clearly at this point, this is a little downtrend within, again, this overall uptrend, because here we have the sideways consolidation. Prices are making in a bigger picture. It's higher. It's still higher highs, higher lows on a bigger picture. If you look at this high, it's higher than this high. So on a bigger scale, this is still an uptrend. But this is a mini downtrend within a bigger picture uptrend. And this downtrend here, once it's created, once we got about, down it to this point, we have a two lower lows, two lower highs. So downtrend right about in here. The downtrend V pivot low, rallies up right to resistance. It's in a downtrend. Prices then sell off, come in for the gap fill, and prices explode higher. Once prices get up and overtake this first area of resistance, this first pivot high, rally right up into here, the downtrend is over. The downtrend ends right at this moment. Now prices are in a little uptrend. This is a little mini uptrend that's happening right in here. Higher highs and higher lows. And it just continues with the higher highs and higher lows. So little mini sideways trend that happened right here. So the uptrend was over. This little mini uptrend ended as soon as this pivot low here was taken out with this bar. Once that happened, this entered a sideways trend. And right now we're taking out the sideways trend. So it's now forming an uptrend. We have a higher high. And let's see if a higher low forms, higher low. So at this point, it's clearly an uptrend. A new uptrend has been reestablished. And now we're into a sideways trend. We got two equal lows. Okay, so prices have clearly overcome an area of support. We're now going up for an equal high. So we're now clearly in a sideways trend. Prices take out a pivot low. Now we have two equal highs, and we clearly have an equal low here, or a lower low that's forming right now. So equal high again. Sideways trend breaking out, and back to an uptrend. There we go. Now we have a lower high, and we are forming a lower low. Oh, a much lower low. So this is now forming a bigger picture sideways trend. See the sideways trend defined here. Even though it's not perfect lower lows, it's just an area. It's only going to be close. No, more than a sideways trend. So here, this is now looking like a big picture. If I go to a larger time frame, this would be a bigger sideways trend that looks like that's forming. But even within a bigger sideways trend, you have these little mini uptrends or even mini downtrends that form. Right, and this looks like the last trend that we just went over. So we'll take a look at trend in one more time frame, and then we'll move it along. So here's a daily chart of the Qs. You can see back in March, between March and April of 2020, we had a low point that rallied and set a low. Prices have rallied, and every time they rally and drop, there's a higher low that's formed. Prices just continue to make higher highs and higher lows. Each time prices rally and drop. Prices rally and drop. So nice clean uptrend where prices rally and drop, and they come right to support and just keep making higher highs and higher lows. Here's a small little equal high, equal low, so a little sideways trend right in here, but then prices break out above the sideways trend, and we're currently continuing the uptrend on the Qs. So beautiful little uptrend on the Qs, and the uptrend continues until prices can overcome the first area of support. So prices would have to drop below this pivot low at this point in order to violate the uptrend. All right. The retracement against the trend describes the strength or weakness of the trend. So here we have prices that rallied, they found a high point, and prices have pulled back. The pullback is only approximately 50%. When I look at the pullbacks, I'm most focused on the bodies. I don't care so much about the tails. Sometimes you get the tail sell off, like in this example, the tail looks like it's sold off 80 or 90%. The bodies, as long as the majority of the bodies remain in the upper 50%, that's really what I'm looking for. So in this example here, I'd call this a 50% retracement. And that is a healthy retracement, and it suggests continuation of the up move. A retracement of less than 50% of the prior move suggests continuation of the trend. All right, so as long as prices are rallying and pulling back approximately less than 50%, it's a healthy pullback and it suggests continuation of the trend. A retracement of greater than 100% of the prior move describes a change in trend. So once prices have a greater than 100% sell-off, it is no longer in the same trend that it was in. There's been a change in trend to either a sideways trend or, in this example, potentially a downtrend. So here we got the cues on a 2-minute time frame. So prices were in a downtrend during the morning period. As soon as a prior pivot is overcome, that's when the downtrend ends. So in this move here, when it rallied up and overtook this pivot high, the downtrend is over at that moment. Then prices rally, a greater than 100% retracement. Now there's been a clear change in trend. Prices pull back right to support, and then they rally from that point. So as soon as prices can penetrate greater than 100% of the prior move, that's when the current trend is over. So in this here's a little mini uptrend right here. So we have prices that rally and they overtake the first area of resistance, which would be this pivot high. So this is a signal of strength, overtaking the first area of resistance, rallying right to the second area of resistance. Prices pull back. They pull back right to support, forming a V pivot high, and then give a wide range bar, closing right at the high, igniting prices to a new high, clearly forming now an uptrend. So clearly this is a high, a higher high, a low, a higher low. Prices rally. They continue the uptrend until prices form an equal high. At this point, it's no longer an uptrend. Price is now entering a sideways trend, and then a pivot low is overcome. So this is clearly a change in trend. Once this happens right here on this bar, taking out these pivot lows, this is the moment where it is a change in trend. So this is just a sideways trend, and the sideways trend is over as soon as prices can overtake an area of resistance. So this whole sideways trend here ends the minute this pivot high is taken out. So not until that move. This sideways trend is intact until prices blow right out of the resistance and take a pivot high with that move. And so here, this uptrend, here you have prices continuing to rally, forming higher highs and higher lows, higher high, little sideways whippy action here. Prices break out again to form a higher high, higher lows, and then prices get slammed right here. At this moment, the uptrend is over. Taking out the pivot low violates the rules of the uptrend, and the uptrend is now over, and it's either going to enter a sideways trend or a downtrend. And so here it enters a short-term, here it enters a downtrend, but it's a downtrend with support nearby. So if you're thinking about shorting this type of move that, you overcome support, you rally back to support, you have a V pivot low, you have a wide range bar igniting, but support is very close. The buyers are going to come in very close. And that's what happens there. So again, here's a little sideways mini downtrend. So you have this bigger picture, scroll this up. We have this bigger picture uptrend. Right, so it's a bigger overall direction of up. This little mini downtrend coming down to support, and this mini downtrend is over as soon as, if you look at the move, each of these highs can't be overcome as it drops. No high points are overcome as it drops. No high points are overcome. Finally, bam, right here, it overtakes a high. This is the moment that shows you the buyers have taken control. So here we have a bullish picture, overall bullish picture. We have a little mini downtrend within a bigger picture uptrend. And this is the first signal that the buyers have aggressively come in and defeated the sellers and they've taken control. So the little mini downtrend is over here at this point. Prices rally up, blowing right through all the areas of resistance. They rally right to the top of it, and then a wide range bar down, closing very bearish, followed by an inside bar, breakdown failure, with prices coming right back through. All right, so here's another uptrend. And this will be the last one, we'll move it along. So prices, as long as the retracements, if you look at the retracements back, it's about 50% of the move. You measure from here to there. Each move, we want to do each move. So as I start at the lows, as soon as it pulls back, so I'm looking at the level of retracement from here to here, the pullback was very strong. Prices rally. Measure now from the bodies here to here, the pullback is only about 30% or less. It's very strong. Now I measure from here to here, the pullback is only about 50%, and it's right on top of support. So that's very strong. Prices rally. Now this pullback here penetrated a little bit, penetrated more than 100% of this little move right here. So a little bit of weakness right here, but if you measure the distance from here to there, it's only about 50%, maybe slightly more. So things were put into question here. You didn't know whether this was going to break out, or whether it was going to continue weakness and then sell off. But as soon as prices rally up and take out this pivot high, that's confirmation that the buyers have regained control, even though there was a little weakness right there. Prices now have retraced greater than 100% of a prior move. If we measure the negative move from here down, this retraced greater than 100% of that. So that's a bullish signal. Prices now pull back, measure from here to here. The pullback is strong, only about 30%, and just keep going. Finally from here to here, and pow. This one comes back, looks like about 80%. But then look what happened after. Prices failed to make a new high. So the greater than 50% retracement, finally on this whole move, there was never greater than 50% retracement. The first greater than 50% retracement against the prior move changed the trend and set up a sideways trend. As prices went sideways, they dealt with the issues from the negative pullback. And then here, where there's a greater than 100% retracement of the negative move from here down, that's now bullish confirmation, sideways tight consolidation of narrow range bars, narrow wide range bar igniting from a period of narrow body bars, clearly breaking out of the sideways trend. Prices rally, measure from the start of the rally here to the high, the pullback is only about 50%. Perfect pullback, V pivot high, right on top of minor support, 180 reversal, wide range bar, closing at the highs. Prices move up, the retracement back down. The retracement from here to here is bearish. The retracement is about 80% or so there, so that's a bearish retracement. With that level of retracement, I would not be looking for prices to move to a new high. And prices don't. Prices rally, and then they form they form a lower high really, and then prices enter a sideways trend for a bit before making one more attempt and then failing. But the first signal that we had that this move over here was going to happen, or that this failure was going to happen, was this retracement that happened. That was the first clue that we had that things were different. There was something, this whole move higher. If we watch the whole move higher, the most bearish move that we see is this one. The most bearish retracement of the entire thing is this one. So this was the first clue that we had that the potential for this to happen was there. Reoccurring wave patterns can help as a predictive indicator of future price moves. Trends typically will follow a 3 to 5 wave pattern. Once a trend has completed 3 waves, the odds for a change in trend increases. So here, if we look at the trend, each one of these is a wave. And generally the market, it doesn't always do this, but generally you will oftentimes see the market make a 3 to 5 wave push. And once you have a trend that's gone 3 waves, it's become extended and the odds for reversal have increased. If you get to 4 or 5 waves, the odds are overwhelming that prices are going to have a significant pullback. And so that's the example here that we're showing, is that this here has 3 waves, and at this point that there's 3 waves, you want to realize that, here's a pullback, V pivot high, pull right back to support, nice 180 reversal closing at the high. But this pattern has lower odds of working out than the one in the second wave or even first wave, because the trend itself is becoming extended. So let's have a look at some examples. So this move right here would be considered the first wave of this move breaking out of this base. So if you look, we have wave 1, the first push. Then there's wave 2, the second push. Then there's wave 3, the third push. And on this one, notice how the third push has the most bullish bars of them all. These bars are the widest range. They're closing near their high. They're bullish. I mean, all these others, other than the first one that started the move, all these others are narrow-bodied bars with tails, small. People weren't convinced prices were going higher, but on the third move, everyone was convinced it's going up. And then you can see what happened as a result after the third wave. Same thing here to the downside. Look to the downside. We have one move down, two moves down, retracement, three moves down, and it's over. That's it. And then you have one move up. Then we have two moves up right here. Then we have three moves up, and now consolidation. So after three moves, consolidation. Then you get four moves, and then five, and see how this one at this point at number 5, it's making the prices are not accelerating to a new high as much as they did in the past. The momentum is decreasing with each push higher. It's running out of steam, and that's what sets up this bigger sideways consolidation, this sideways move down here. And after prices then consolidate and cool off a little bit, creating this bigger sideways trend, the waves continue. The wave starts again and continues. So wave 1, consolidation, wave 2, consolidation, wave 3, and then you got an M top, pow, and you enter a sideways consolidation. So you can see 3 or 5 or as much as 5 waves. It's definitely something to pay attention to in the market. Doesn't mean that it always happens. You can see here, this is just prices didn't really move in a wave type of pattern. They just kind of rallied and declined with no clear wave pattern. So it doesn't happen all the time, but it happens common enough. It's common enough to take note of and pay attention to. Here's another. These nice strong momentum moves. A move like this is what I'm looking for. Here we have a real strong move for leg 1 or wave 1, real strong move for wave 2, real strong move for wave 3, and then you get one more little poke higher for wave 4, but see how it just pokes a new high and gets slammed till it enters a sideways consolidation. So there's 4 waves, 4 pushes. So again, the odds, if you're entering a position on wave 1, is far higher than entering a position on wave 3 or wave 4. Because even this pattern here is a V pivot high. Prices pull back right to support. Looks beautiful. You get this wide range bar here, igniting prices. Looks gorgeous. The only problem is it's the 4th wave of a trend. And so the odds are increasing that this will fail. And I just want to find another strong momentum move where it's clear to show the nice 3 to 5 wave pattern. Here's Apple Computer, but you can see here the moves down. So we have one wave down. Prices consolidate, wave 2, prices consolidate, wave 3, down, then back up, wave 1, prices consolidate, wave 2, prices consolidate or pull back, wave 3, and then prices attempt for a wave 4 and they break out and it fails. Prices come back in. And then here's one where it looks like multiple waves. You have wave 1, wave 2, wave 3, wave 4. Well, look, it looks like a little mini wave if you actually look at it closely. Wave 1, wave 2, wave 3. Then you get a strong pullback with consolidation. Then you have wave 1, wave 2, wave 3, wave 4, wave 5. So little mini waves within this bigger picture, but as I look at the big picture, it doesn't look like a clear 3-wave unless if you look, if we look at this whole thing as wave 1, sideways consolidation, wave 2, sideways consolidation, and then wave 3 or 4. But paying attention to 3 to 5 waves is definitely important, but it doesn't work every time. But when you see it and it's clear, you want to make sure to take note of it. Get one more on Facebook or Amazon. Here's a clear 3-wave pattern. Here we have Amazon that breaks out this momentum move, sideways consolidation, and prices break again for the second move, sideways consolidation, prices break again for the third move, and then you have a gap up that ends it, and prices now sell off. So there's a nice 3-wave pattern, and it ends the move. And here, 4 waves. Look at Amazon coming to the downside. You have wave 1, consolidation or pullback. Wave 2, consolidation. Wave 3, consolidation. Wave 4. And prices have a strong reversal. Okay. Patterns. The markets are always moving. A professional trader has discipline to wait for high odds repetitive trade patterns. Reoccurring trade patterns increase the odds to help predict future price moves. The markets and securities are always moving. You must be disciplined to wait for your trading opportunities. The most important job you have as a trader is protecting your money. Only putting your money at risk with high odds trade patterns will help ensure your success as a trader. Bullish buy setup. Criteria. Uptrend. Fluid pullback to support. V pivot high. Less than 50% retracement. Potent reversal bar. Action. Buy above potent reversal bar high. Stop loss under reversal bar low. Bearish sell setup. Criteria. Downtrend. Fluid rally to resistance. V pivot low. Less than 50% retracement. Potent reversal bar. Action. Sell short below potent reversal bar low. Stop loss above reversal bar high. Okay, let's look at some examples. Here, this is the Qs on a minute time frame. So this is a beautiful bullish buy setup. We have prices that are clearly in an uptrend here. We have a strong momentum move. We have prices consolidate sideways with narrow range bars, and then prices break out of that area with a wide range bar igniting. Prices then pull back, creating this nice fluid pullback, this nice V pivot high. Prices pull back right to the top of support perfectly and create this. This bar really didn't, we didn't have a bottoming tail or a bullish reversal. This bar did end with a tail on it. So entering on this bar would not be ideal in my view. I would not enter this bar, enter at this time. In this pattern, the entry, even though it's right up near resistance by the time you get here, but until you can show a real bullish signal, you can't enter the position. So this one is entering a little higher than what I like, but this bar right here, this wide range bar closing right up near its high, given this overall uptrend, V pivot high, fluid pullback, and notice again on the pullback here, the biggest down bar is the one right at the end after several bars down. So we have everybody throwing in the towel as prices come right into support. So this is a really nice pattern. The only thing that this one lacks is that perfect potent reversal bar, but like I said, we did get it. However, it's a little high entering, but it does suggest to enter above the high of this bar with a stop loss down to the low. So the stop loss is a little wider than what I like in most cases, but it is a very nice pattern. So we'll continue with some other examples, but the picture of this breaking out above a consolidation, beautiful fluid pullback, the range expanding on the way down, the V pivot high, everything about it other than the potent reversal is really perfect. So with that, we'll find some other examples. All right, we'll take a look at this one. This isn't completely perfect because it's not a completely perfect V pivot high, but it is definitely a pattern that that is tradable. So we'll talk about it because not everything is going to be perfect. We're not always going to have perfect V pivot highs. So as I see them, we'll talk about them here. But this one here, we have this strong momentum move and with sideways consolidation in the upper 30% of that strong momentum move. So very bullish price action. Prices consolidate, then they break out again with this momentum move. So very bullish price action, clear uptrend. Now prices pull back. And look at the pullback comes, if we measure from there to there, it's approximately 50%. Looks like it might have poked down just slightly more. I wouldn't be entering on this reversal at all, but what I would do is as it comes up and then pulls back, now we get a range expansion bottoming tail. And then we have this extremely potent reversal right here. So above the high of this bar here, this pattern, even though we have this small consolidation that's here, and this isn't a perfect V pivot high, given that this is a nice uptrend at this point, the strong momentum move here, the sideways base, the momentum move here, the fluid move down in here, this tells me that I would believe in the moment that prices would certainly overcome this little bit of resistance. So entering above the high of this bar is definitely a very nice pattern. So continue to look for a few more. All right, so there's a couple here on this chart that we're looking at, and first I'll talk about this one right here. So here is a clear, beautiful uptrend. Prices consolidated sideways here. Prices broke out of that consolidation, so clearly in an uptrend. Now prices pulled back right to support. There's bottoming tails, and then we even get, so either entering above the high of this bottoming tail right here, that's a great entry on this pattern, or even after a couple bars later, they get this real negative red bar that has no follow through, followed by the 180 reversal. So above the high of the 180 reversal bar, or above the high of the bottoming tail. It's a very nice V pivot high, perfect momentum move, pullback, everything about it is really nice looking. Another bullish buy setup is this one here. We have strong momentum move. The only negative thing I'll say about this one is that it's happening on the third wave. So we have one wave, two waves, and then three waves. So this one here ultimately does work out, but it is extended, and you can see that even though this is a really nice V pivot high, it's a perfect pullback right to the top of support. We have these bottoming tails. We have this potent reversal. In my view, the reason why this pattern didn't just explode is because it was happening after three waves. So the picture is very nice. However, it is an extended trend, and this one ultimately did continue to work out. However, look at the trouble that it had getting going, and in my view, that is because it's happening on the third wave. So again, the picture is nice. In this example, the potent reversal is nice, the V pivot high, the pullback to support, the 50%, all that's nice. It's just that it's happening after three waves, which increases its risk. Okay, here's another bullish buy setup. This is the 5-minute chart of the spiders on July 30th, 2020. We have prices sell off to the downside. Prices rally, form this V pivot high, rally range expansion bottoming tail, and then prices rally up, overcoming the V pivot high. So now we have an uptrend established, or it's establishing an uptrend. Prices pull back to form a bottoming tail. The pullback is approximately 50% of the rally. the pullback is stopping right on support where it's supposed to stop, and it gives us a nice bottoming tail. You enter a position long above the high of the bottoming tail, and you'd place a stop loss for protection under the low of the bottoming tail. So this is a very nice V pivot high, bullish pullback after a greater than 100% retracement, now forming an uptrend. So very nice pattern right there. So keep looking for a few more. All right, here's a really nice bearish sell setup. Here, there's this really nice consolidation sideways, and prices break below the consolidation. And this is ideally what I like to see for any bullish buy setup or bearish sell setup, is that prices for the first time decisively break below or above a consolidation, and then prices retrace back to it. So here prices clearly broke below these pivot lows and this big consolidation after this big extended move to the upside. There is plenty of price void below. There's plenty of distance from the low here to where the next area of support is. If we look over here, where's the support? It's down in this area. So as prices break below this consolidation, and then they retrace back to it, right back to the lows, right where it should rally to. Prices create a V pivot low, and right here at the high, there is this bullish bar, breakout bar, breaking above the highs of this little consolidation, these two equal highs, and then you have this topping tail with this potent reversal. So right after the topping tail bar and the potent reversal, under the low of the potent reversal bar, is a beautiful entry on this pattern with a stop loss above the high of the topping tail. Given, in this case, if we measure the amount of resistance above versus the amount of support below, it's overwhelming that this pattern here would drop, especially given the distance from entering here. Where is the real support? This is a V pivot low, doesn't offer a lot of support. If I look to the left, you got this little blip of a thing, and you got this consolidation here, or the pivot lows. That's what you'd be looking at. So very nice pattern right there. You see, here's another. Doesn't give a perfect V pivot high or anything, but you can see, the same concept of pulling right back to that support. Prices rally, then they rally again. They pull back right to the top of support, and then they rally again. So even though this is a little sloppy, you can still see the pattern, the stair-stepping pattern of the bullish buy setup. Here's another one, bearish sell setup. This is very nice right over here. We have prices, whipping around, and then they decisively take out these pivot lows. Decisively take out the pivot lows after forming lower highs. Now prices rally right back to the pivot low, exactly where you want to see it. Forms a V pivot low. Now on this time frame is a 5-minute chart. On this time frame, it doesn't give an entry bar because the entry bar wound up down at support, so it was so big. But maybe on a smaller time frame, if you're looking at this picture on a 5-minute time frame, again, I don't see any real entry here to say, because I would never suggest entering below the low of this bar with a stop loss above. It's too big of a bar. But if you see this picture and then we could drop to a smaller time frame, there might be other information there. But in this example, I can't do that because I can't scroll back that far on a 2-minute or 1-minute time frame to get the data. But this is a very nice bearish sell setup. Less than 50% retracement of the previous move, retraced right back to resistance, V pivot low, and it's missing that real potent reversal. But again, drop to a smaller time frame to see you can get any of those time frames confirming what this time frame suggests. And here's another bearish sell setup. Very nice. This is a very nice looking one here. So here prices were in an uptrend. Then prices finally have their first greater than 100% retracement, overtaking the prior pivot low. Now prices rally right back to the area that they should, right at the pivot low, right at the support, or at the resistance. Creates a V pivot low, and then gives a potent reversal. You enter short right underneath the potent reversal low with a stop loss above the high. So very nice bearish sell setup right there. Another bullish buy setup right here. Here we have strong momentum move, sideways consolidation, prices break above, prices drop right back down to it, and this here gives you the wide range bar down into support, followed by the inside bar, and then the potent reversal taking out the highs of the inside bar or coming back to take out the high of the wide range bar down. So very nice V pivot high, pull back to support, 50% retracement, bullish move. Here's another V pivot high right here with a bullish buy setup. You get this pullback right into support. This bar closed right at its high. You look in there, so you have this bar closing right at its high, less than 50% retracement against the move, right back into support, bar closing at the high. You enter above that bar. All right. Breakout. Criteria. Uptrend. Bullish momentum move. Tight consolidation. Less than 30% retracement. Potent bullish bar. Action. Buy above potent bullish bar high. Stop loss under potent bullish bar low. Breakdown. Criteria. Downtrend. Bearish momentum move. Tight consolidation. Less than 30% retracement. Potent bearish bar. Action. Sell below potent bearish bar low. Stop loss above potent bearish bar high. All right, let's look for some examples. Okay, here we've got a nice one on the Qs in a 5-minute time frame on August 20th, 2020. So we have a strong momentum move here. And then prices consolidate sideways in the upper 30% of that strong momentum move. Prices then within the consolidation form this little breakdown failure. Here, if you look at this bar, we have all these equal lows. Then we have prices breaking down and then followed by a 180 reversal up. And then that's followed by another red bar that has no follow through. And when it's followed by another bullish 180 reversal. So above the high of the second 180 reversal is where I would suggest entering, even though the first 180 reversal does give you a nice entry in this example. I don't ideally like to buy the first bullish signal that I see within these sideways consolidations. Generally, you will get more than one bullish signal when you have a sideways consolidation. So I personally do like to wait for the second or even a third, or if it's just breaking out above the highs of the consolidation. This consolidation here had big tails, so entering above the highs of this consolidation might not be an effective strategy. But if you have a tighter consolidation with the highs more equal, you can enter above the high of the consolidation, or in this example, an ideal entry would be above the high of this bullish 180 reversal with a stop loss under the low. Here's another breakout. You have this nice strong bullish move. And ideally, the way I really like these patterns the most is that they have a real strong momentum move like this example that are then followed by these short, tight consolidations and breaking out. This is a very nice pattern. This one here is a little whippy. They do get prettier than this, but that's the overall general pattern is you get this strong momentum move followed by a short, tight consolidation with continuation. But here is a nice bullish move, a nice strong bullish move. And then look at the nice sideways consolidation here. And this here is like the example I just gave. I said, the first bullish thing that happens within the consolidation I don't generally like to buy. I like to do the second or even third in some examples. But if you look here, the first bullish thing we have happen when prices are consolidating sideways is this bullish wide range bar. I don't like this consolidation right here. Really, at this time, it doesn't look like it's gone sideways enough to me. I like to see a nice sideways base like you've got the second one. Here you have this real nice bullish 180 reversal right in the middle of the pattern. That's a very nice bullish 180 reversal. This one here in the moment may give me enough confidence to enter above the high of this. But if I'm not entering above the high of this bullish 180 reversal, by the time the third one here happens, the information is absolutely clear that this pattern is going higher. With the failures of the red bar closing right at its low and failing to follow through, followed by the bullish 180 reversal, the bullish retracement against the move, the consolidating right on top of support like it should, everything about this pattern suggests buying above the high of the bullish wide range bar, or in this example, you could buy taking out the highs of the consolidation because the consolidation is nice and tight. Here is another, same thing. If you look closely, we get this strong momentum move right here, and then prices consolidated sideways. This nice short consolidation, prices consolidate right on top of support. This here was support, support, and you get this nice bullish 180 reversal. So this is another nice strong move, sideways consolidation, bullish 180 reversal, and prices continue. Nice breakout. Here is another breakout. This here is done with a gap, but if you look at the gap as the momentum move, so we get the strong bullish move. Now prices consolidate sideways. This one here is a longer sideways consolidation, but still a very nice pattern. And if you look at the information within the consolidation, here we have this like a bullish buy setup pattern here. There's no support to the left, but you have a bullish buy setup with a V pivot high, bullish potent reversal, prices rally. And you get this little double top with this negative bearish 180 reversal and prices drop, but they really have no follow through when it's followed by a potent reversal and a 100% retracement back up, showing there's no follow through to this. So the sellers weren't able to take prices down very much. Prices then have another red bar closing right at its low, a wide range bar igniting from a period of narrow bodied bars. Lots of narrow body bars in here, wide range bar closing at its low. The message is this should send prices lower, and it does not. So when you have a bar, a bearish bar that suggests something negative and there's no follow through, that's a bullish signal. So we have a bullish signal here. This is no follow through. Prices come right back up again, and then they pull back and form this strong wide range bar, bullish, closing right at its high. I personally can't say I'd be entering at this time. I would definitely be looking at this pattern as very bullish, and I would be definitely looking for this pattern to move higher. But the moment of entry for me of complete confidence would absolutely be the little baby bar here that closed right at its high, or taking out the highs of these pivots. You could either enter on this bar, taking out those highs, or enter on the bar closing right at its high just before it breaks out. Those on this pattern would be the two very nice entries for the breakout right there. And then here's another break. Oh, did we just go over this one? The sideways consolidation, and then prices breaking out above the highs of this consolidation. So nice tight, you get a strong move, nice tight consolidation right on top of a previous consolidation, and prices breaking out above the highs. That's a nice breakout there also. See if we can find any really nice clean breakouts and breakdowns. See, this is very nice right here. This is small and it's a little whippy in here, but this is the very nice picture. Here you got this strong momentum move right here. And then you have this sideways consolidation remaining the upper 30% of that move, and prices just taking out the highs of the consolidation. Didn't go very far because you're always, on top of patterns and where you're entering, you want to consider where is resistance, which we'll go over. But for now, it's the picture. I know this pullback here was hard. But if you ignore that, it's the picture of the strong momentum move followed by these small tight consolidations that hold up in the upper 30% of those moves. That's what the picture that we're looking for. And we'll go over targets and the distance to resistance in the chapters ahead. Here's another nice breakout. We have this strong momentum move here, breaking out above this consolidation. Strong momentum move, nice tight consolidation. And then within the consolidation, we have this red bar that has some follow through initially, but it winds up being a bottoming tail, trapping anybody who had gone short or sold. Then prices form this other bottoming tail bar here. And then this bar taking out the highs of the consolidation. This would be the bar to enter on at the close of the bar or above the high of the bar. This bar suggests prices would continue higher. So it's a nice breakout pattern there. Strong move, tight sideways consolidation, taking out the highs or a bullish bar, combination of bars within the consolidation. Here's another breakout. Sideways consolidation, strong momentum move. Sideways consolidation of narrow-bodied bars. Wide range bar taking out the high of the consolidation. It's a very nice breakout right there. All right, here's another example of a nice breakout we have on the diamonds. This is a 15-minute time frame. You see we have a nice strong momentum move here. We have this wide range bar down followed by the inside bar. Prices surge higher. And then we have this nice strong tight consolidation with all these narrow range bars. And then in here we have a little breakdown failure pattern where prices break down. Then we got a bottoming tail bar followed by this wide range bar closing right at the high, igniting prices. So it's a beautiful breakout pattern right there with a very nice breakdown failure igniting the breakout. And here's a few more breakout patterns, very nice patterns. Here's a real nice one right in here. We have the gap up as the momentum move. So a nice strong momentum move and then a real nice tight consolidation sideways. And within the consolidation, we have this red bar down, a breakdown bar followed by the inside bar. So a breakdown failure right here. And then we have these little bars closing at the high right within the consolidation. And then the wide range bar igniting. And then you have a breakdown failure right back into the base of the breakout point. Again, this is another breakout followed by a tight consolidation in here. And then we got little small bars closing right at their high just before prices breaking out. And within the consolidation, we have a breakdown failure pattern here. And we have a bullish 180 reversal right in here. So very nice breakout pattern here and here. Another breakout pattern here as well. Got the strong momentum move to the upside. 30% less than 30% retracement, tight consolidation, and prices just breaking above the high of the consolidation. So another nice breakout. Series of breakouts here on the diamonds on a 15-minute time frame from August of 2020. Extended break of support. Criteria: sideways trend, extended fluid multi-bar decline to support, break below support, potent reversal bar. Action: buy above potent reversal bar high. Extended break of resistance. Criteria: sideways trend, extended fluid multi-bar rally to resistance, break above resistance, potent bearish reversal. Action: short below potent bearish bar low, stop loss above potent bearish bar high. Okay, here's the first one we'll go over. Here we have this sideways consolidation. And to look at it bigger, so this is a very bullish move. So we have a very bullish consolidation sideways after this really strong move, strong gap up, prices consolidating sideways for this period of time. Then we have prices sell off, this nasty bearish move. Prices sell off and they take out the lows of the consolidation. That suggests that prices should be making a move to the downside. When you have the sideways consolidation, prices break those lows, traders are expecting that prices should continue to move lower. Even look at the range of the bars in this example, how they expanded in range and the biggest bar is right at the end. So it's really nice that that happens. This really looks very negative, but it's a very negative short-term move within an overall bullish long-term picture. So we have a negative move that takes out the lows of the entire consolidation. Now this did not give us a beautiful breakdown failure or a range expansion bottoming tail or something nice that we could have bought at the lows here. So this is not the best example, but it's the concept that I want to go over on this one, where when prices are consolidating, people are expecting this bullish consolidation. People are expecting prices to break out. Even look here at this strong bullish breakout bar closing right at its high. This clearly suggested that this should break out. Everybody who is buying, just look at within the pattern, look at what's happening here. Here's like a breakdown failure. It's a sloppy looking thing, but prices broke to a new low and bam, they get slammed right back up with a greater than 100% retracement of that prior move. Then look at the double bottom that happens here, the retest low, and look at the bullish 180 reversal with a bullish wide range bar. Look at the bottoming tails, bullish reversal, wide range bar, closing near its high. Another strong bullish bar, red bar with no follow through to it, ending in a bottoming tail. All the information within this breakdown, within the sideways consolidation, is suggesting higher prices. Even here, look at the bullish 180 reversal. Gorgeous picture right there. Prices rallying strong. Then they fail. Finally, they give in. Everybody gives in and they throw in the towel and that's it. This thing's not going higher. You can see their agreement as prices going down and then prices don't go down. They rally. And here they give this sideways consolidation and then prices break above that and give another sideways consolidation. So in this example, ideally, we'd love to be buying down at the low with a bottoming tail or a 2-bar consolidation with a range expansion followed by an inside bar, something like that. This didn't give us that, and that's okay. It's not going to happen every time. You're not going to get perfect patterns every time. But there will be other ways to get on board, and that's what we'll talk about in this example. Because when you have these sideways consolidations, it's very common that when prices take out the low of the consolidation, that is going to ignite prices to the upside. Because what happens on this move down is that every person who put their stop losses under the lows of these pivot lows, all the people that were going long in here, as these people were going long within this pattern, they have an expectation that prices will move higher, but these people become sellers in the future. So they become future resistance. But what happened on this move here, as prices came down and took out these lows, those traders' stop losses get hit. So they exit their positions down in here, which removes them as future supply. So now the market can move up easier because those people are no longer in. Also, this type of a move, anybody who had been bearish within this pattern and thinking of shorting it, well, once prices take out the lows of the consolidation, this is the point where the bearish traders are shorting. And in order to close a short position, you have to buy in the future. So this stopped out some people who were long that would become future resistance. And it also sucked in some traders short, causing them to be future fuel, buying fuel to continue the move higher. So that's what is so powerful about a move like this down. Now, it didn't give us the perfect low that we want, but it does go up and consolidate and give a nice breakout entry in here, breaking out. Or once you have this one here, prices break above a little consolidation and they consolidate sideways again here. This is now the level of retracement back down, the potent reversal, taking out the lows, even though this is near resistance here. In my view, it's still okay to enter above the high of this bullish bar right here. The reason, even though it is so close to resistance, the reason why is my expectation given this pattern and the number of times I've seen it in the past, that once you have prices take out the low of the consolidation, prices are now going to take out the high. It's not common that you see prices take out the low of a consolidation, then just come back in and keep consolidating. Or they may consolidate for a little bit and then they break higher. So my expectation is entering here that what happened here is exactly what would happen. Prices would continue to move higher. So that's one example. The market has been very strong lately, so there's not a lot of examples of these bullish buy setups. Here is another one. It's not too clean, but we'll go over it and the concepts because there aren't going to be that many of these clean patterns I've been searching for in the market environment. You know, everything happens in waves, even in the market with market patterns. You know, you have a period of time when it's the bullish buy setup, then you have a period of time when it's the extended buy setup, and a period of time when it's the breakout. Things just kind of tend to happen in waves, and currently there haven't been a lot of these extended buy setups, so I don't have that many great examples to go over on these small time frames for education. But here we have, all right, prices are clearly in an uptrend. All right, prices pull back, they form this nice pivot low, prices rally, then you have this nice decline. And you have the wide range bars at the end of a move coming right down into support. So that's an extra added bonus in this example, where this is a clear uptrend over here and prices are coming down and they take out this pivot low and the support right here. That makes this a little bit of a bonus. Even though the decline, it does create this little consolidation here, and then down in here is a bit sloppy. By the time though you get this bar, so you have this bottoming tail, I can't say I'd be buying above the high of that bottoming tail bar given how sloppy the move down was. But once you get this strong bullish bar closing right at its high, that tells me that this is going to work out, that the pattern, that the odds of the pattern would work out. And even though the move down wasn't ideal because of the consolidation, the information that I'm getting here, because of taking out the low, bullish uptrend, right on support, range expansion, bottoming tail, bar closing at its high, range expansion, it would tell me that this is, you know, going to continue higher. Here we have another range expansion, bottoming tail, another bullish wide range bar, and then prices come down for the breakdown failure here. Consolidation sideways, wide range bar down, inside bar coming back through. So even though this one here, it didn't just come down and give us that beautiful entry and move up, but if you look at the information, it's the concept of the extended move down in an uptrend to support and taking out the lows of support. Because whenever you take out the lows, you're stopping out traders who were long. You know, some traders who took this long put their stop loss below here. And again, those traders that are entering here, they are future supply at some point. So if the market can come down and stop those traders out, it removes them as future supply, making it easier for the market to move higher in the future. Here's a extended buy setup. This might be the same, just a smaller time frame. I think it's the same one we went over, but a smaller time frame. But if you look at it, this one here looks much cleaner. Here we have clear sideways trend. And again, this is bullish. Things are bullish. So when the picture is bullish, we only talk about going along. And prices have this strong sell-off, taking out the prior pivot low. And then giving a potent reversal, followed by right in here, you get a bottoming tail, and then a red bar with no follow through, with this bar closing right at the high. It is at this bar closing at the high would be at the point above the high of this bar that I would be entering on this position. This is the point that tells you that the lows, that this is not going to sell off. If this were going to sell off, look at the wide range igniting it down, taking out the pivot low, prices rally, retrace right back to the pivot low. This red bar should have follow through. This is the point where prices, as short traders, should be shorting it, looking for it to come down for a gap fill. When this red bar had no follow through and was followed by the 180 reversal up, that is now enough information that the sell setup is going to fail and the bullish picture that we see is intact. And when you have a bullish trend and a bullish picture, the failure of something bearish is a reason to get long. Here's another one we'll talk about. It's a little sloppy, and it didn't take out the lows, so it's not perfect. And ideally, I really like it when they take out the lows, and for the reasons we've gone over of it stopping out traders or even sucking in some short traders to provide extra fuel. But again, there aren't that many great examples, so we'll talk about the concepts and the different things that I see anyway here. So prices sell off. You got this wide range bar. Again, look at the lots of red bars, and the biggest red bar is right at the end, coming right into support. Then you have another nasty red bar, completely negates the bullish green bar before it, takes out the low. Looks like it's just going to continue lower, and it doesn't. It's followed by this very strong bullish 180 reversal, closing right up at its high. So this picture here, entering above the high of the bullish bar, way too close to resistance. This cluster of bars here, it's a mess. I cannot say I'd be entering, even though the picture, I can tell you, looking at this right here, when I'm looking at that, I am not thinking down. There's no way I'm looking at this and thinking that the market's going to drop. This tells me that this is going to make it through this resistance. However, this resistance is going to be dealt with. The market will react to it. It's not common that you see prices just blow through a cluster of bars like this. So the information of the range expansion into support after a multi-bar move down, the no follow through to the red bar here, the nasty red bar, the bullish wide range bar up, that's all telling me that this is going to go higher. And then you have, you know, this pullback, this really nice pullback. Look, it's like a VBS. It's like a bullish buy setup, or it's really a double bottom is what this is. You get a V pivot high here with a pullback right to support, retesting the bullish 180 reversal with a bottoming tail. This is the point to enter this position. So even though this one did not take out the lows and it did not give a clean fluid pullback, a perfect ideal clean fluid pullback, this here is still a nice buy setup. Again, another one here. This is not too clean, but it's the picture and it's the idea. Look at the sideways consolidation. The markets have also been very bullish lately, so we're not seeing a lot of sell patterns. I'm only able to go back 10 days or so, so there's not a lot of these extended sell setups, but it's really the exact same thing, just flip the picture upside down. So here we have sideways consolidation, prices making equal highs, relatively equal highs, relatively equal lows, and then there is, again, this isn't a perfect ideal sell-off, but it is, you know, because it has a sideways consolidation, but it's the concept. Prices still break below the consolidation, taking out the lows. This really looked bearish, and then followed by a potent reversal right after taking out the lows, and it comes back up. I wouldn't be buying after the high of this potent reversal. In all honesty, I can't say I'd be buying this picture at all. Unless I'd be buying it up here. This is where I would truly be buying it. You know, this is way too whippy for me, but it's the picture. If you get enough information, there will be another entry, another cleaner, strong entry, and that's what I'll show here, is that you got the nice sideways consolidation, prices take out the lows of the consolidation, prices give a wide range potent bar coming right back through the breakout point, trapping traders. You then have a topping tail that has no follow through when it's followed by a bottoming tail, and then prices make a 100% retracement of the past two moves, so coming right back up to the pivot high. This is now very bullish. It's giving you confirmation, telling you that this market is absolutely not going down, and after taking out the lows of the consolidation, as I mentioned in the last example, if you take out the lows and it doesn't follow through, that's most likely when you're going to rally and take out the highs. So that's what I would be expecting. After this comes all the way back up to these highs, I would have the belief that prices were going to break out of this consolidation. And so I'd be looking for another buy setup. And that's clearly what you get right here. You have this sideways consolidation. This here looks like a minor little bullish buy setup. You got a little V pivot high, pull back right to support. You got this little confusion bar here that's followed by the bullish wide range bar closing right at the high. This one, again, if this is happening at resistance, resistance is here, resistance is here, resistance is here. So there is risk, associated in that moment. However, given everything that we've gone over, everything I've discussed about the belief that once you take out a consolidation like that, you're now going to take out the highs. So looking at this, I'd be looking at I wouldn't focus on these points here. My belief would be we're going to overcome those. And I go to the next area of resistance. I'd be looking at this pivot high here, which is a V pivot. So my target on this would be the belief that prices would go to a new high. And they do so in a hard way. It gets up there choppy, and you can see it initially goes up and gets slammed back down, but it then holds and goes up. So taking out the lows of a consolidation is usually what sets up the breakout. All right, let's move it along. Climactic buy setup. Criteria. Extended momentum vertical move. Minimum 3 waves. Expanding in range after an extended move increases the odds, but not required. Price breaking support or at support increases the odds, but not required. Potent bullish reversal. Action. Buy above potent bullish reversal. Stop loss below potent bullish reversal. Climactic sell setup. Criteria. Extended momentum vertical move. Minimum 3 waves. Expanding in range after an extended move increases the odds, but not required. Price breaking resistance or at resistance increases the odds, but not required. Potent bearish reversal. Action. Sell short under potent bearish reversal. Stop loss above potent bearish reversal. All right, so here is an example. We have the Qs in a 1-minute time frame on August 24th, 2020. Prices have sold off. You can see they sell off hard and they sell off right into support. So the fact that the prices are in and have been in an uptrend, and this sell-off is coming right down into support, that increases the odds for this pattern versus there being no support or this being a downtrend. I like that this has been in an uptrend and there is an extended sell-off into support within a bigger uptrend. So those are two very big positives about this pattern. Also, the range expansion is right at the end of the move. The biggest, nastiest bar of this entire move that started, other than these ones over here in the very beginning. But over here, look at all the bars, and this wide range bar igniting prices from a period of narrow-bodied bars, and then the range contracts as prices go down, prices retrace, and then the range expands, giving the range expansion the biggest, most nasty bar right near the end of this whole move. So the range expansion, after several bars down, increases the odds, and also support, as well as the overall bigger uptrend, increases the odds as well. Prices then sell off a bit, and they come out and take out the lows of the prior low here, and ends a bottoming tail, followed by a potent reversal, and followed by another potent reversal. This pattern strongly suggests buying above the high of the bottoming tail bar. Ideally, the picture that's down here, they can get prettier at times, and for education, it's hard to show the perfect pictures sometimes. They do happen, but a lot of times things won't be perfect, and we'll use multiple time frames to help increase our odds of and also the clarity of the pictures we're seeing and what's going on. But this picture here is, even though I can't show the perfect breakdown failure or the perfect range expansion like I would like to, the overwhelming information here of everything that we're looking at that I've just gone over is overwhelming, that buying above the high of this bar here strongly suggest that the market is going to move higher. So that's a very nice quality pattern. The only thing it's lacking is a better picture for educational purposes to give a potent reversal or some type of bottoming pattern, but everything else is absolutely beautiful about that. Okay, so let's look at some examples. Here we have a real nice example. Prices have, if we look here, prices have been in a clear uptrend, and prices broke above support very nicely, sideways consolidation. So these two things are not required for this pattern, but certainly increase the odds for this pattern. So because we're going long, and anytime we go long, ideally you want to be in an uptrend, you want to be on support. So here we have a clear uptrend and we have support. Next thing we have an extended down move into support. We have 3 waves down. Here's leg 1 for wave 1, here is wave 2, and here is wave 3. So we've got 3 waves. We have a breakdown failure. We have this sideways consolidation right here, followed by this wide range bar. This is the widest range bar of the entire move from all the waves when it started. Here we have bars expanding in range a bit, then retracing, expanding in range a bit, and the biggest bar is right at the end. So the biggest bar of the move right at the end, 3 waves down into support in an uptrend, and we have a breakdown failure here. Another one, we have sideways consolidation, and we have this range expansion, bottoming tail. So you have sideways consolidation here with a range expansion taking out the lows, followed by an inside bar. But then even the inside bar gets taken out, and it's taken out with a range expansion bottoming tail. Very powerful. Buying above the high of the range expansion bottoming tail, or even buying above the high of this red negative bar. Either of those 2 points are very good points on this pattern. It's a very clean, very nice looking extended buy setup. Okay, here is a climactic sell setup on Apple Computer. This is a 1-minute chart on 8/21/2020. But here we have this really nice uptrend, nice sideways consolidation. Prices break out from, beautiful breakout here. Another little sideways tight consolidation with a breakout. Prices have, so we'll count wave 1 here, sideways consolidation, wave 2, sideways consolidation, wave 3, sideways consolidation, wave 4, little consolidation, wave 5, little consolidation. This is the 6th push, the 6th little push, and finally we have a breakout failure, a potent reversal bar with a breakout failure. So we got the little 2-bar consolidation, which is ideally how I like to see these bars end. A little consolidation with the breakout bar followed by the complete reversal. So this would be the sell setup, is shorting below the low of the red bar. Now in this example here, I'd like to show how prices are not in a downtrend. There is no resistance over here. And as I scroll, you can see prices have really only been in an uptrend. So unlike the last example, this one, even though this pattern does work out, this pattern does cause prices to drop, the odds of this one are lower than the example I gave last, because the last example was prices had a climactic buy setup into support in an uptrend. So this is a climactic sell setup, but it's happening within an uptrend and there's no resistance to the left. So it does show exhaustion, and you can see this example, it does work out, but notice how hard, how choppy it was. Prices pulled to support and they reacted. It failed to go higher again, then they pulled back to support and it reacted, didn't go higher, kept going lower, but it was a very hard move down. If you were in a short position, you were watching your account go all over the place. And that's not ideally what you want to see. So just to point out those examples, the picture of this, of having this radically extended move with multiple waves within the move, and then the 2-bar breakout failure right at the top, that's perfect. Okay, what is negative about this is it's in an uptrend and there is no resistance to the left. But it is a very nice pattern and it did work out to the downside. So there it is. We'll see if we can find some more. Here is another one on an Apple computer. Again, this one, things again have been very bullish, and overall Apple computer is in a bullish picture from the 19th and 20th 2020 time frame. But it's the picture we'll go over, and hopefully you'll see it. But as you see, we have this multiple wave move up. We have this vertical strong rally with multiple waves, at least 3 waves. And then right at the top, this is ideal. We have this 2-bar consolidation followed by the wide range breakout bar. And this wide range bar is one of the biggest. It's actually a lot of big bars in here, so ideally they would be bigger, but it is a big one. It does close right up at its high, which is what none of these other bars have done. So finally, the first bar that closes at its high within this entire move is right at the top. So that's a plus for this pattern. And then it's followed by a topping tail bar. Now it does get whippy here. Again, it's in an uptrend, so you can see if you shorted underneath the low of this, yes, it worked out for you somewhere, but it was a hard ride. And the reason being that overall, Apple's been in an uptrend, and anytime you're going to short in an uptrend, this is the type of stuff you can expect. It's going to be a fight to get your profit. So I don't recommend shorting stocks in an uptrend, but it's hard for me to find these hard sell-offs because the market has been so strong lately. So there is the picture once again. It's a beautiful pattern. Definitely one to take note of and one to pay attention to. Okay, here's another one. Now the picture of this one at the low is getting very clean, very nice. This is the type of picture that I want to see. So we have prices moving down. You got one wave here, sideways consolidation, second wave, sideways consolidation, third wave, potent reversal, but it fails to go to a new high, and then it sells off again, giving a fourth wave down, takes out the low, and gives a potent reversal that has no follow through, and then it's followed by the breakdown bar, the wide range breakdown bar. Here is, one of the most bearish wide range bars of the entire move, right at the low. And this is what I like, is the 2-bar consolidation followed by the wide range bar. So this is a range expansion, very bearish bar, and then it's followed by the inside bar, bottoming tail. Buying above the high of either of these bars is the entry point, or buying above the high of the breakdown point once it comes back through right up in here. This would be the area. So ultimately prices did go higher and then they went down, but that's the sell setup. You got the climactic buy setup. You got the multiple waves down, you got into support, and then the picture at the low on this one is getting very clean. So ideally this huge move right here wouldn't be there for this pattern. Ideally that wouldn't be there, and it would be a much cleaner looking pattern. But on this one, I want to point out the low because that's very pretty. So if combination of some of the other examples I've given with this one here would be ideal. It's the breakout and breakdown failure that I really like at the highs and lows of these patterns. So like here's a breakout failure right at the highs, prices rally up, give the little consolidation with the big bullish bar followed by the inside bar. That's the picture that we want to see at the bottom and lows, at the top and lows of these climactic buy and climactic sell setups. All right, here's one more to go over. This is Amazon on a 2-minute time frame on August 24th, 2020. But beautiful picture right at the low. It's not ideal the way it come down with 3 waves coming down exactly the way that we like them, but this pattern is very extended from resistance, the resistance points being here, and we have the widest range bar of the entire move right at the lows. We have support to the left, and it even took out support, which is more bullish. So we cleared the base, coming right down into a stronger area of support. Very, very bullish. Widest range bar of the whole move, and then this is ideal. We get the 2-bar consolidation, and then look at this nasty red bar followed by this perfect bottoming tail closing right at its high. That picture is ideal. This is exactly what you want to see at the low of these patterns. The odds of this right above the highs of the bottoming tail bar is overwhelming. Very, very nice pattern. So other than doesn't meet the criteria of the perfect 3 waves down, obviously it does have an extended move. It's got 1 wave here, 2 waves here, 3, 4, 5. So it's, if you look, you know, the concept is it's extended, and it is extended to the downside. It's right in support. It's extended from resistance, and that is perfection. All right, so let's move it along. Double bottom. Criteria. Potent bullish reversal. Fluid pullback to retest potent bullish reversal. V pivot high. Uptrend on one time frame above. Potent bullish bar. Action. Buy above potent bullish bar high. Stop loss under potent bullish bar low. Double top. Criteria. Potent bearish reversal. Fluid rally to retest potent bearish reversal. V pivot low. Downtrend on one time frame above. Potent bearish bar. Action. Short below potent bearish bar low. Stop loss above potent bearish bar high. All right, here's an example in the 1 minute time frame of Apple Computer and the 2 minute time frame of Apple Computer. Okay, here is an example on the 2 minute time frame of Apple Computer. You can see here we have a strong bullish move. Then we have a sell-off on this time frame, and now this is, I do require an uptrend on one time frame above. And the reason being that sometimes on the time frame you're trading that's going to get the double bottom, you formed a mini downtrend. So I really want like a mini downtrend within a bigger uptrend. And so this is a 2 minute time frame. It's August 20th, about 10 a.m. or so. So if we go to a 5 minute time frame and August 20th, about 10 a.m., this is the move. So you can see it's clearly an uptrend. Prices have rallied. We've overcome resistance. So the time frame above, and if we scroll back, it's an uptrend. Okay, so Apple is in a clear uptrend on the bigger time frames. Then we come to the small time frame, the 2 minute chart, and you can see here we have this nice pullback. The pullback is only 30% of the previous move. The pullback came right to support as it should, and then we have here, this is a breakdown bar closing right at its low, taking out the lows of the consolidation here. It's then reversed, so there's a potent reversal, strong retracement back up, penetrating into the previous decline. And then prices pull back to retest that breakdown failure and give another potent reversal. So this is the point above the high of the bottoming tail, or the potent reversal bar here. There is a nice double bottom with a V pivot high, and this is happening within an uptrend. So it's a very nice little double bottom right there. Look for another one. Here's another nice double bottom that's on a 2 minute time frame of Apple Computer, and it's about 8:17 or 8:16 on 2020. But here we have a strong move up, and we're on a 2 minute time frame on what do you say, 8:17. It's 8:17. Again, its prices are clearly, well, we're at least in a sideways trend. Prices are not in a downtrend. Let's find out exactly where this here is. The double bottom is here, 12 p.m. on 8:17. 8:17, approximately 12 p.m. Okay, so this is not an uptrend, but you can see this time frame is more like a sideways trend. We've been in more of a sideways trend, so that would still be okay to me, especially looking at this picture. If you look here, we've got this strong breaking below the lows, potent reversal, strong retracement against the prior move. Did not penetrate 100%, so that would certainly raise some caution to me. But if you look at the strong move and then the consolidation here, it's remaining the upper 50% of that move after a bullish retracement, so that is strong. So I take the message from this that the most recent move is strong. The pattern is bullish. However, it did not overcome resistance, so that is a concern. And then I would take that message to the smaller time frame, the 2-minute chart, and I'd see what information is either confirming that the move will go higher or confirming that it will go lower. And as we look at this, I have a strong move, and then we've got a pullback. And now here's our potent reversal. So we have this bar that takes out the lows of the consolidation, followed by a real strong potent bar. So it's this bar, then prices pull back. They do give a V pivot high here. There's a sideways consolidation, but what I like is that this here winds up a breakdown failure. So we get the sideways consolidation, followed by the range expansion bar coming down to retest the potent bullish bar. That's followed by an inside bar and a bottoming tail. So buying above the high of the bottoming tail is ideal. And that's a beautiful double bottom retest. And I wouldn't, because of the breakdown failure pattern, I would not be concerned with this little consolidation right here. I would just be looking at, there's a V pivot high above that, because the failure of this breakdown bar is going to fuel prices through the resistance that will come in from here. So very nice double bottom pattern right there. New low reversal. Criteria. Potent bullish reversal. Pull back to new low, retesting bullish reversal. New low followed by a bullish potent reversal. Uptrend on one time frame above. Action. Buy above potent bullish bar high. Stop loss under potent bullish bar low. New high reversal. Criteria. Potent bearish reversal. Rally to new high, retesting bearish reversal. New high followed by a bearish potent reversal. Downtrend on one time frame above. Action. Short below potent bearish reversal low. Stop loss above potent bearish reversal high. All right, so here we have the cues on a 5-minute time frame, and looking at this pattern, it looks similar to a double bottom, and this pattern here gives us a beautiful V pivot high, which is perfect. They don't have to be a perfect fluid move down when they poke to a new low, but the cleaner the move down is, the better. So a nice fluid move does increase the odds. So this looks just like a double bottom pattern. It's just that it just pokes to a new low, which makes it more potent than a regular double bottom. So this gives the V pivot high. This is happening on an area of support, which is an increased bonus. And there is a range expansion bottoming tail closing very bullish. So entering above the high of the range expansion bottoming tail. This pattern is a very nice new low reversal, just how it pokes to a new low with one bar and snaps right back up again. So very nice double bottom or new low reversal pattern there. Another here, not as clean, but still the message is the same. Certainly we'll go over this. So we have this nasty red bar down right into support, followed by a potent reversal. Prices rally, give a V pivot high, and there's a fluid move down on this one, which is very nice. Fluid move down takes out support by one bar, and then you have a reversal. Now this isn't a potent reversal back through here just yet, so I would not be entering on any of the combination of bars at the low here. But after prices rally, they give this negative red bar, and the retracement back up is pretty strong, and then it gives this negative red bar followed by the 180 bullish bar up. So by the time you get this bullish wide range bar up, this is confirmation that this pattern is not going to go any lower. And so I wouldn't be entering on this bar because it's too large and it's right into resistance. But after it pulls back and gives this red bar down followed by the bottoming tail, this would be the point to enter this pattern that would suggest you'd then look for a gap fill or prices to move up higher into resistance with that pullback. So the ideal entry, we would love to be in down at the lows if there was a combination of bars down there allowing us to do so. In this example, there was not, but there was at least finally information and an entry, a good strong entry right up in this area here. All right, take a look at a couple on Walmart. Use a 5-minute time frame. Here's a new low reversal here. So we have prices dropping down right into an area of support. So the picture is bullish. So overall, we have a bullish environment. We have a negative move, but it is a bullish environment right on support. And that's how I like to be going along, is buying something negative in a bullish environment. So prices have a strong move down. There's a potent reversal here. Prices then decline, and see, this decline isn't perfectly fluid. There's a little consolidation in here. That's just fine when you have prices poke to a new low with a potent reversal. So you can see how prices just go to a new low with one bar, and then immediately after one bar, they slam right back up with a wide range bar igniting. Now, I would not enter above the high of the wide range bar igniting because it's far too big of a bar with far too wide of a stop loss. But after prices had cooled off and given this little consolidation, actually I would be entering above the high of the red bar, but I'd be doing it over here. At this point is when I would do it. I would not just do it immediately after this green bar. I'd let prices cool off a bit, and then I would be entering when it breaks to a new high right in here. So that's a nice new low reversal right there. Here you can see again, it doesn't give the double bottom type pattern, but it's the same idea, same concept, where you have this consolidation and then look at prices drop down, poke to a new low one bar, and then monster right back up again. So this strongly suggests higher. So even take a look at the bullish buy setup that happens after. Even if you miss this entire move, the information that you get from this move, the rejection of prices to move lower here, should really give you confidence in the bullish buy setup that happens just after that, with it pulling back perfectly to support. If this instrument was going to go lower, it would have done so here, not after this type of retracement and then this pullback. So very, very beautiful bullish buy setup right there. But nice sloppy new low reversal, but I hope you can understand and see the message of when it takes out that new low, the power of when they come right back through again. Here's a new high reversal. So the only thing I'll say I don't like about this one is that it's on support, but the picture here is nice, so we'll go over it. It's not, the environment has been bullish, so it's not going to be a lot of new high reversals in a downtrend. But here, the picture of this is very nice. We have a high with a topping tail and a strong reversal, so it's a strong reversal here on this side. Then prices rally up and they poke to a new high by one bar, and it ends at topping tail, and then prices get slammed back through. So the point of entry on this, I wouldn't enter it up here, but once you have this really negative bar down, closing right at its low, it is a wide stop loss, but the picture here, once that bar happens, this tells me that there's a bigger down move that's about to happen. So this is a nice pattern with the wide range bar down, the V pivot low, and after this extremely negative move. So high odds for this to produce a move that follows through after the negative red bar coming back to the breakout point. All right, here we have Netflix on a 5-minute time frame, and what I like about this pattern, it's a little bit sloppy, but there's a new low reversal followed by a new high reversal. So we have this negative move down, and you can see how it pokes to a new low just with these one bar and then a range expansion bottoming tail. The range expansion bottoming tail suggests that prices are going to move higher once that happened, then followed by the wide range bar up, this and then a 180 reversal up. So the new low reversal, you can see the power of the reversals that happen when you make a new low and they don't follow through. But then after this market then rallies up, it goes to a new high reversal and pokes up to a new high of the day just by 1 bar. And with these new high and new low reversals, I do like them to be close. I don't want to be calling this a new high reversal compared to this point. That's far too wide. We want it to be like a M top or a W bottom. So something really ideally like this, like you have these M pokes to a new high and get slammed right back down. So it's the shape of an M. The points should be close together. I only point this out because this example that I'm giving over here, it's a questionable new high reversal on this time frame. Maybe if we switch to a 15-minute chart, the date on that was okay, so we switched to a 15-minute time frame, and here it is, August 11th. So this is a much cleaner looking new high reversal on this time frame. So you can see now we have the V pivot low. This is actually really nice looking, where we have a clear downtrend. We have this rally retraced right back to resistance, and it just pokes to a new high by just 1 bar and then gets slammed. So very, very nice looking new high reversal. Doesn't have the other side over here for the M, but this pattern of the high here, new high of the day, 1 bar and getting slammed. So very, very clean, very nice looking new high reversal on the 15-minute time frame. And on the 5-minute time frame, as we pointed out, that was a new low reversal that had formed, and then it's a new high reversal in a larger time frame. So there's a nice picture there. All right, here's another example. Today I just went to the CNBC market movers list and just having a look at some of these to see if we can find some patterns. And so on GPS today, this is gap. You can see prices had a nice momentum move with this nice breakout pattern. Get a 15-minute time frame. Strong momentum move with this nice sideways consolidation for a breakout pattern. You can read the information within it. So a very bullish picture. And then we have prices accelerate higher with the gap up, and then prices just have this nice fluid move down with prices decreasing in size and declining in momentum, and then prices have a range expansion bottoming tail that takes out the low of the day just by 1 bar and bounces right back up. So this just poking to a new low of the day by 1 bar. This is a great entry right above the high of the range expansion bottoming tail. That's a very nice pattern with this nice clean fluid pullback, and the way they pulled back coming down just to poke to a new low of the day by 1 bar. Very clean, very nice looking pattern. All right, here's another on the 15-minute time frame with the spiders. A little sloppy, but same information. Very nice pattern, very strong message from this. But right in here, we have this wide range bar down, followed by a bottoming tail inside bar. Prices coming back up through, negating the wide range bar down, having no follow through. This is then followed by a V pivot high with a fluid pullback, which is only 1 bar, but is a fast bar pullback, which is then followed by a range expansion bottoming tail. Very powerful bar. Look at the size of this range expansion bottoming tail, and it took out the lows of not just the low that it just created, but also the prior low before that. So where this bar took out those 2 lows and wound up a range expansion bottoming tail closing near its high, the odds of this moving higher is overwhelming. This is a very, very nice looking picture, very nice pattern, trapping many traders within this bar. The traders who created this bar, there were many traders who shorted this bar. Lots of traders were selling on this bar, and by the end of it, they all found themselves wrong. So a lot of power from this bar and very nice pattern. Trade management. Trade management is one of the most important jobs you have as a trader. Knowing when to exit a trade is just as important as when to enter. we will use the concepts we have gone over to help us determine when it is the correct time to exit a position. Targets: consolidations, pivot highs, pivot lows, unfilled gaps, three-wave pattern, range expansions, and trailing pivots are the tools we will use to determine when it's time to exit a position. Okay, so here we have a bullish buy setup with a nice fluid pullback to support with a V pivot high. Now the first area of consolidation is over here to the left, but this area has been penetrated by this V pivot high. So all I'm really focused on at this point when we're down here is the V pivot high, which does not leave a lot of resistance, and prices should be able to move through that area. So the next areas that I'm going to look at is target 1 as the V pivot high, but I do believe prices could move through that area, but that is the first area of resistance. The second area, we would just continue to the left. I'd ignore this because it's unpenetrated, move up, and the next area of consolidation, this here would be target 2. From there, I would continue to move higher and I would do the unfilled gap. I would do the bottom of the unfilled gap as well as the high of the unfilled gap. And then I would go to the pivot high as well. So these are all the different target points that we have when entering a position down here. Now, when you're entering a position, we have absolutely no way of knowing where prices are going to go to. All we can do is enter, and then we'll use the concept of bar by bar analysis, trailing pivots, and the other things we've gone over to help us determine the odds of prices either continuing or reversing once they move into these important areas. So we buy above the high of the bottoming tail bar and we place our stop loss under the low for protection to minimize any losses there could be just in case the trade does not work out, and not all trades do. Prices accelerate and they move through target 1. Now at this point, everything looks very healthy. The range of the bars is a healthy range. There's nothing suggesting reversal at this time, so there would be no reason to exit the position. Prices then consolidate and move sideways for a bit. Now they start to move higher. At this point, the way we can manage our trade to make sure we maximize our profits or reduce our risk while the trade is in play, is we move our stop loss up each time a pivot low is formed. So once we have the completion of a solid pivot and prices begin to advance, we can move our stop loss up just underneath the low of that. And at this point on this particular trade, now your risk, you would, even if prices were to come down and hit your stop loss, you would actually turn a small profit because you can see the stop loss price is now above the entry price. So at this point, the trade is guaranteed at least something for profit. Prices continue, and looking at bar by bar analysis, there's nothing here really that's suggesting that we should exit the trade. As prices move higher, the range of the bars is staying pretty equal relative to their past. They're all about the same size. They're not expanding. There are no real potent reversals. So prices have now moved up into target 2 area, and they have penetrated a little bit, weakening this area. So currently everything still looks okay. No reason to be exiting at this time. But now there is a new pivot low that is being formed. So this is a point where you could now go ahead and move the stop loss up to just underneath that pivot low. So because at this point, once you have these potent reversals or a pivot low form, if prices continue to remain bullish, these pivot lows should not be overcome. Now prices accelerate, and now you can see the range of the bars is expanding, and price is now accelerating away from support. Whereas on this past rally, you can see how prices never really became extended from support, because support was just right here at the minor pivot high, which is where the bottoming tail stopped. This move now is accelerating away from support. So from here, you are now moved into target 3. You're at the bottom, you're into the gap fill area. Maybe it does push a little bit higher. You might get up into target 4 or maybe even target 5. Who knows where this thing is really going to go? We never do. But at this point, we now have, there's 1 wave, 2 waves, 3 waves, consolidation. You could call this 1 wave or wave 4. Prices are finally getting extended. The whole trend is becoming extended. And at this point, this is where you should be thinking, sell your position. Not saying to sell just yet. There's no information to sell just yet, but your frame of mind should be thinking, this is the area where you're going to be exiting. And now that you have range expansion, the odds are increasing that there's going to be a potent reversal. Okay? At this point, prices then consolidate for 2 bars and then give a breakout failure pattern. At this point, you should absolutely be exiting the position. If you see that there is one of our sell setup patterns, this is time to exit. Right? So anywhere, in my view, while in this trade, anywhere from, you could let things go just as they come into your target areas, or as the range of the bars expand, you could just be throwing it out there and letting it go. Or if you continue to hold on and then you see some type of potent reversals setting up, those are clearly messages to exit the position. So the rules would be, you could either exit the position while moving into targets. You can, and of course, as well as seeing information that suggests doing so, like a range expansion or potent reversals. Okay, so if you see anything like this, these are the reasons to get out. Or the other things would be taking out a pivot low. There's really no right answer to how to manage a trade, and every trade will be different. Some trades you're going to use bar by bar analysis. Other trades you're going to trail stops. Some trades you may trail a prior bar low. It really depends on your strategy and each trade and the distance to resistance. How much space you have for the market to move is going to make a big difference in how you're going to manage the trade. For example, if we had a lot of resistance over here and I was buying this bullish buy setup here, just as prices came up and poked through this high, regardless of if I have a potent reversal or if I have a range expansion or not, if I have a strong resistance point over here and I've got some good profits moving up into that, that might be enough. You might take the trade right there. So each trade is going to be different, and it really is going to depend on what you have to the left and the amount of resistance. So with that, let's pull up some examples. And we'll just go over some different trades, looking at the charts of how it's possible to manage. So here, there's the Qs in a 15-minute. We'll drop to a little smaller time frame. All right, so here we had this bullish buy setup here, or a breakout. We could start with either of these. So this breakout pattern. When you're buying a breakout pattern like this, we have no idea that this type of a move is going to happen. And so how do you capture your profits? Is the question, and it's a hard question to answer. But when I'm entering the position down here, I know that resistance is right up in this area. And this has been a strong move. And sometimes with these strong moves, they do this, they poke up, and then they come back down again. You don't want to give back all your profit. So, this might be the type of thing where, I don't even see the range of the bars really expanding. There's no potent reversals. Nothing really bad is happening here. But if I see prices, moving up on a pattern like this with it being so close to resistance, this could be the thing where, for no rhyme or reason, just other than I like the profits I have, you might want to think about just exiting. You just let it go. And sometimes I've done that in my past, and they keep going. And it's a part of trading. It's what you have to deal with. So just to throw that out there is one thing that you're going to deal with as a trader. But other ways that these positions can be managed, if you had managed pivots, if entering at this low and then you're letting it pull back against you, form a pivot low, and then moving your stop loss, you would capture this entire move. All right, because you would continue to move a stop loss each time a pivot low is formed. So stop loss will be moved here after this happens, and then a stop loss will be moved here after this over here happens, and then a stop loss would be moved here, and you'd be stopped out right up in here if you had trailed pivots from the breakout at the low. If you were going to manage pivots every time though, however it works out excellent in this position, many times you'll watch yourself have nice profits on a trade and then you'll give it all back. That's the problem with managing pivots every time. So in this example, it does work out perfectly, and it may be one that you utilize many times. However, if you're using it every time, it's likely going to lead to some frustration. Here though, if we follow along using bar by bar analysis, so if you do a combination of pivots by allowing prices to pull back, as well as bar by bar analysis and resistance. So starting with this move, as prices had moved higher, the range of the bars did not expand. Everything acted very nicely. Prices did come into an area of resistance and they reacted, which we expect. Prices then pull back. The pullback would be a hard thing to sit through because, of course, you watch yourself go from having nice profits and you gave it all back for a period of time. However, it's followed by the inside bar and then explosive bar higher to give a bullish buy setup, and prices continue. Now, this time on the rally, it starts with the wide range bar, and now here we have the range expanding. So now we have the range expanding. It's not a huge range expansion, but prices are finally expanding and they are coming deeper into the area of resistance. At this time, prices also, the market is becoming extended. You have one move, two moves, so this could be considered the third wave. And in the moment when you're looking at nothing but a range expansion coming into an area of resistance and it's followed by the inside bar, this again is information to me in the moment where I would likely be exiting my position looking at a picture like this coming into resistance over here after this type of a move up. Again, we have no way of knowing that this type of thing will happen. So I'm trying to be as honest as I can with being able to see what happens. But in the moment, that's likely where I would exit using the tools that I have to the best of my ability. So let's go ahead and look for a couple of more simple trades that are nice patterns that we can talk about here. So we have this this is a really nice breakout pattern. I'd be very, very interested in this. Looking at this type of price action throughout the day, throughout the whole morning period, coming right into 1 o'clock, bar closing right at the high here. This is absolutely beautiful. I'd exit this, I'd enter this position and then look at the bar by bar analysis of this position. As prices move, these are all just narrow-bodied bars, so not a lot to react to, and prices have broken above resistance, and they're clearly in an uptrend. So everything here just says hang on, and you have these little tiny pullbacks against your position, but there's nothing very bearish about it. Even though there's a couple of negative bearish bars in here, there's no follow through to them. So just hanging on throughout this information and looking at this, prices again break up. And you have some bearish bars, but again, no follow through, no nasty pullbacks against the position. Little tiny pivot low is taken out here, but again, this is where your stop loss should be. If you entered down here and moved your stop loss when prices broke out, you should move it under the low of this base and let this base do what it's got to do and form. You will see little breakdowns. You will have bearish 180 reversals like this one. So if you're reacting to these and exiting your position, you're not giving the trade enough wiggle room to have the battle take place. So you want to make sure not to move your stop loss too quick, because if you move in your stop loss at the first little bullish thing that happens, you're going to get stopped out very quickly. So make sure not to move your stop loss too quick. Let a battle take place. Let clear pivots form or clear consolidations form and a clear decisive break above the consolidation before moving your stop loss. But here, really just other than this one negative thing here, which you can see had no follow through to it, prices retraced 100% going into the end of the day. This is all very bullish price action. There's nothing here that suggests exiting after entering a position here. On the next day, when you get this gap up, prices now become accelerated away from support. So, this thing could pull back anywhere, as it did. It pulled all the way back to support. And when you're up here like this, that's what my thought would be is, who knows, we love to see it keep going. We always want that to happen. But the reality is they can come all the way back in. So once I see some selling pressure coming in, here we have a green bar. And then, after that, you get that green bar ignored by the low of it being taken out. Once I personally see some type of weakness or the buyers giving up the strength that they have, it's time to just exit. Lock in your position and take your profits. So always be thinking, protect your profits. Protecting your profits is the most important thing you have to do as a trader. It's just as important as making the money. Saving the money or keeping the money is just as important as making the money. Here is a real nice bearish sell setup. We have this sideways consolidation. This is beautiful. Prices break, so we have this bullish uptrend, which is followed by this sideways consolidation. Prices break below the pivot low decisively and then rally back to it with this V pivot low. Perfect, with a perfect potent reversal. So very nice pattern here. You would enter at the low of the potent reversal with a stop loss above the high. And on this pattern, from here, I would have a target. I would look at the V pivot low, but the V pivot does not offer a lot of support. So my belief would be that would be target one. The first area of support in a short position is always target one. You want to see what happens there. As a matter of fact, you can see here, this looked like it potentially was setting up to be a new low reversal. If you look what happened, nice fluid pullback, a V pivot high. This bar wound up a range expansion bottoming tail. And then the next bar initially was taking out the high of that bar. Now, prior to the close, it wound up being a nasty red bar. But there was a time when this was looking like it was setting up the potential to be a new low reversal. And so that's why you always do want to have the first areas of support or resistance recognized as your first target point, because you never know what's going to happen. But the new low reversal failed, didn't happen when this bar ended a nasty red bar. So below target one, I would then go to the gap fill. So the top of the gap fill and the bottom of the gap fill is what I'd be looking for. And then the pivot lows down in here. So this general area is where I'd have a target. As prices come down, you can see what happens. The range expands. So as the range has expanded, coming right into a pivot low, it's time to exit. There's in no way would I be holding on, waiting for a pullback and trailing pivots with this type of an extended move down into support. You know, it's time to exit the position. And if this were going to continue lower, then you let it retrace back up and you see if there's another pattern to suggest getting back on. Although again, in this example, you can see in this, for exactly why, you can see in this example what happened. Now, ultimately, prices did go lower. But look what you would have had to sit through, you know, to do that. These range expansion bottoming tails, new low reversal, powerful reversal up, powerful reversal up. I mean, you literally gave back 100% of your money before it finally then went lower. So this is stuff I can't sit through myself, and that's why exiting at times like this is best, and then hit the sidelines. All right, here's another nice sell setup, bearish sell setup, same thing. So we have this nice little uptrend that's happening here. Prices come right to resistance, and prices finally have a failure and break down decisively below this pivot low. So this is an area, a general area that's likely for reversal because of the resistance over here, and then the resistance that's now created when prices break below this, rally back to it. Perfect sell setup. And this time frame doesn't give a beautiful entry, but if you are entering on a smaller time frame in here, the targets again would be, first would be the pivot low, the V pivot low that's created. However, in this example, prices blow right through it. The second target would be the next pivot low right over here, and again, prices blew right through that. And then the third targets would be the consolidation here, which is the first area prices reacted to. And then the second target would be the pivot lows here, which is the next area price reacted to. And then the third low would be the last target. And then below that, you can see we have no other references. And that's why, as the range expanded here, you can notice that this is an extended move down. You get this range expansion, but it didn't stop prices this time. And the reason why is because this came into an area of price void where there was absolutely nothing to stop prices over here, nothing over here. So when you have these extended moves coming down and range expansions coming down into areas of support, it increases the odds for reversal. But in this example, prices came down, they became extended, but then had an increase in momentum as it took out the lows of this consolidation with no areas of support to the left. And that's what enabled this one to keep melting down. Here we have this is a sloppy bullish buy setup, but if, you know, looking at it if we just go over the targets and the management of the trade, how we can handle it. Here we have a strong momentum move for leg 1. We have a little consolidation. We have a break above. Now we get this beautiful pullback right to the top of support. And it's a little sloppy in here, a little sloppy reversal, but let's just say if you were to buy above the high of this, how do we manage the trade at this point? We enter the position above the high of the bar that closes at its high. We place a stop loss at the low. Target 1 would be the pivot high here. Target 2 would be the consolidation right in here, and it's just a general area somewhere in here. And then target 3 would be starting at the low of the consolidation here and right up to the highs. So this would be my third target. So target 1, target 2, target 3. Now as prices accelerate up, there is a wide range bar coming right into the first or the second target that we have, and then a series of narrow range bars. So there was no inside bar followed after this wide range bar, so I'd probably still continue to hang on. The range contracted, but see nothing potent, no real potent bars. Even this little bottoming tail, it just hardly penetrates into the prior bar. This small bars didn't have any follow through to it, but then look what happens afterwards. This little sideways consolidation, breakout, wide range breakout bar followed by the inside bar. So there is your breakout failure pattern. This is actually a climactic sell setup. So we have wave 1, wave 2, wave 3, and then 4 for the breakout failure. So, and also right into an area of resistance. So very nice climactic sell setup. So that is clearly a reason to exit this position when you see that picture. Right, here is another very nice sell setup. And so we have prices consolidated up at the top. We have this M top or double top type of pattern with a breakout failure here, and prices get slammed, come down, prices break below support, and then they rally back up right to resistance with a V pivot low. So the targets, we get this nice breakout bar, topping tail, potent reversal. So entering below the low of the potent reversal with a stop loss above the high of the topping tail, and target 1 would be the pivot low. Target 2, you would come over to the consolidations. This stuff here I wouldn't even pay attention to. It's far away. I like the stuff when it's to your immediate left, right to your left. This is far away and it's small, so I really wouldn't pay attention to this. I maybe recognize it a little bit. I'd look for price to react to it a little bit. As you can see, this one bar right here, notice how it has a tail on the top. So there was buyers that came in initially from this area, and that's likely because of this little blip of support, but they didn't last long. The next real area I'd be looking at is this larger consolidation here and the low of that consolidation. So this would be my second target. The first target would be the pivot low. The second target would be this area here. And the third target would be the pivot lows right in this general area here. As you enter the trade and then the management of it, if you look as prices continue to go down, there's just red bar after red bar. Each bar can't even take out the high of the prior bar. So absolutely no reason to exit this trade the whole way down. The range finally expands. Not even a huge range expansion, but it finally expands right at the end. It is the biggest bar from the first bar. It's the biggest bar, and it comes right into support. Once you're into support, that right there is reason enough to exit the trade. But look at what happens here. We have prices drop, and then we have a spinning top bar, and the spinning top shows us that there is something that is clearly different from all of the previous bars. Even though each of these bars has not been able to overcome a prior bar's high or have any real buying come in, this bar, there was erratic behavior, there was confusion, there was definitely buyers, and then there was sellers. So a lot of information is being told to us about this bar. And when you have something like that happening into an area of support after prices are already extended to the downside, and there's one leg, two legs, three legs, you got the range expansion into support, those are all reasons to just exit the trade. But in this example, again, if you were to manage pivots, you know what, if you were to manage pivots, you wouldn't get out any higher, because you would have moved your stop loss to this pivot high once prices sold off, and then maybe you'd move your stop loss to this pivot high, but then prices came back through it. So you're still exiting at the same point, but you have to sit through a lot of garbage. So my preference is bar by bar analysis and exiting positions into my target areas. Trailing pivots is something I only do when larger time frames confirm. So if I have in intraday trading, if I have a 60-minute time frame and a daily chart that are suggesting much larger moves, at that time I'm going to come down to the smaller time frames such as a 5-minute, 2-minute, and I'm going to trail pivots when I see bullish patterns because I want to capture those bigger moves. All right, so on this one here, I know I talked about this earlier, and I love this type of pattern when you have these bullish consolidations. I mean, very bullish picture here. You can see just the whole trend was extremely bullish. Everything prior was extremely bullish. This real bullish sideways consolidation. Then we have this real nasty sell-off for the extended buy setup. So how do we manage this trade? And myself, I'd be entering a position on this trade. There's nothing clean at the low, so I'd be entering somewhere with like the breakout right in here or the breakout right up in here is where the entry would be. And if I was entering a position this high, myself, I'd be entering likely above the high of this green bar that closes very bullish, and I would place a stop loss under the spinning top bar just before it. It's got a lower low, and I want to give the trade a little bit of room. I don't want to give it too much. I don't want to have a huge stop, but I have to give the trade enough wiggle room. And this type of a battle that took place here, if momentum is really going to be strong, prices should never come back below this low. So I would be entering above the high of this bullish bar, and I'd be placing a stop loss under the low of the spinning top bar. From there, after prices break out, now this is an example, this type of a sideways base and breaking out from it suggests to me that a new long-term trend is being formed, or a continuation of a long-term trend is happening. So I want to capture that move. So the only way to capture that move is to allow for prices to really wiggle around. So after prices had this momentum type of move up, taking out the whole consolidation, that tells me this will continue. So I would likely for quite some time keep my stop loss wide so that you can allow this consolidation to happen. And you want to allow things like new low reversals like here, right? You have prices come down, they form this sloppy pivot, but if you're moving your stop loss up so fast, you get taken out. So that's why keeping a stop loss down here and letting the battle take place, letting the negative stuff happen against you, and letting the buyers come in and show you confirmation that the things will continue higher. So I wouldn't move a stop loss until I got prices really breaking out of the consolidation. Even here, when prices broke out, I would then wait for them to pull back and then go again. So after it pulls back, it came all the way back in, but then finally it breaks and goes out. Once this move over here was happening, that's at the point when I would move my stop loss from where I had it initially with my entry up to just under the base. And I'd go to the lows of the base, just under the lows of this base. So this is where I'd move my stop loss to. Prices then rally and move. And once they really get going, this is the point where you can now start to trail the pivots, and especially when they become extended. Here in this whole move up, from this point, the first major pivot low you have is way down here. So at that point, to really tighten things up and to start coming to the minor pivot lows, is a good idea. So if you're now trailing here, trailing these little minor pivot lows, you're getting stopped out right up in this area. And I think this might, well, that is the high. But so keep a stop loss loose if there's reason based on the bigger picture that there's going to be a bigger move. But once the move really increases in momentum and gets going and becomes extended from support in the time frame you're trading in, you want to tighten that stop up to at least trailing the minor pivot lows and focusing on bar by bar analysis. Right, new low reversal pattern here. So on this new low reversal, if in the moment, if I was entering the position, now when I get this nasty move down and into support, this doesn't look clean to me. I would not be thinking of entering it this time. But after prices pull back and give this range expansion bottoming tail, which is actually a little mini new low reversal relative to this low. So we have a mini new low reversal happening within a bigger new low reversal. So I really like that. I really like this message right here to tell me that there is going to be a pop higher. This right here tells me that this should spike back up into this area here. So, and given the sloppiness of the move down, that is likely how I would trade this initially. I would enter above the high of the range expansion bottoming tail bar, and I would have a target of the first area of consolidation. And because of the way that this dropped and the questionable pattern, how it's just not perfect to me, I would likely just exit my position as prices came into this area. So as I get this range expansion and this other bar and then momentum stalling out and a red bar here, I would likely be exiting right into it, right in that area. And whether I'd be re-entering down here or not to take that, I can't suggest, but I can't tell you I would, but if I did, it's a very nice pattern. If you enter again above the high of the inside bar, or ideally as it comes back through the breakdown point right in here, if you're entering here with a stop loss underneath, at this point target 1 is here, but these breakdown failure patterns, they blow right through resistance, those first points of resistance. So I would certainly recognize this as an area that price would react to. You could see it did with a little tail here. This bar has a little tail on it, so there was some selling pressure that came in as a result of this, but it wasn't much. It didn't last long. And that's what my expectation would be, because these breakdown failures, they suck traders in, so it provides the fuel to blow right through these first areas of resistance. So from here, if you're entering, I'd be looking for prices to move deeper up into this area. This would really be my target 1. We will still call it target 2. So this would be target 1. But my expectation still, if you look at this overall picture, I can't go back any further, but everything is bullish. It's just a bullish pattern. And in a bullish environment, when prices are trending, you make higher highs and higher lows. So my expectation based on this pattern, once it really got going and prices take out the high of this pivot high and range expansion here, this is really telling me that this has good chances to continue and to keep going. So just exiting as it come into position 1, in this example, with the information of the overall trend would tell me I would likely be hanging on for it to go through the first pivot. I can't predict way up here, but I would be believing that something like this, I might be exiting my position right up in here. If I saw this type of stuff, certainly coming into the end of the day, I wouldn't be holding overnight probably, and I'd be exiting my position right into here. All right, so here's a pattern on Apple Computer. We have a nice strong momentum move here and sideways consolidation followed by this wide range bar igniting. So if you were entering a position on the wide range bar igniting, you're placing a stop loss at the low of the wide range bar igniting. And this type of a pattern where prices are now extended, so we have this strong breakout, prices are extended from support at this time, so we want to have a more aggressive style trade management, be more ready to exit, be more defensive, versus when you're entering a position down near the beginning of a new move rather than somewhere in the middle of a new move. So here if you are using bar by bar analysis and looking at each bar and the range expanding and potent reversals, once prices get up into this area, you can see this series of bars, they're wide range, but you have wave 1, wave 2, wave 3. Now you have a pullback little bullish buy setup, nice bullish buy setup, and it rallies and it pokes to a new high, giving a new high reversal. So this is an M top new high reversal with a V low. So this type of a thing, if you are not just exiting because you have profits and you have wave 1, wave 2, wave 3, things are extended, you have the range of the bars expanding, it's time to just let it go and be happy. There's nothing wrong with that. But if you don't, then if you are sitting through and waiting for that absolute picture, the information to tell you now is the time to get out, then clearly when you see this type of a new high reversal and momentum, that the sellers really gaining control over the buyers. I mean, on this entire move, as we look at it, the sellers just had no control. The buyers have had complete control. But then once you get up into here, one, you can see the sellers have taken control a bit because there's a bigger pullback than anything in the past. And then you have prices accelerate to a new high and they get slammed right away. So the information all up in here clearly says that there's been a difference now in the control the buyers have over the sellers. So that type of information should really just be enough to say, get out. But if you don't, if you still aren't getting out there, if you're managing the pivots, you know, you're trailing from here, you're moving to here, and then you're moving to here after this happens, then you would be exiting your position right at this time over here once prices took out the low. Once they're taking out the lows of this, there's really no reason to be in this trade any further. And another is gap fills here. This is a nice little breakdown. It's a little sloppy, but I can see there's a triple top up here, 3 attempts to move higher, prices fail to move higher, prices come down, retrace 100%, and then there's this bearish 180 reversal. So a little sloppy, but you know, rather than talking about the entry of the pattern, I think you understand the patterns we're looking for now, but the trade management. The other thing I want to point out here is the gap fill. Gaps are areas of support and resistance, and they're areas that lots of traders will take action. So look at the information that we have. If you were to enter a short position under the lows of this, the targets you'd have would be from here, you'd be looking left, and you would look at this area right here, the top of the gap and the consolidation of bodies right in there. So this general area here, which is right where prices really stopped, except for the range expansion bottoming tail that came down to almost fill the gap. Not quite, but it came close. And so gap fills, these are areas that we want to focus on as targets. And here, if you look at what happened, this was a huge range expansion, wide range bar, huge range expansion ending right into a gap fill with prices being extended in a bullish environment, a bullish picture. So that type of thing, if you were short, then there's no reason you should not be exiting somewhere down in this general area just based on prices being extended into a gap fill in a bullish environment. Okay, another here to go over this one more on the Dow. We have the Dow that's formed this bullish pattern, and we have a nice strong gap up in the Dow, nice strong sideways consolidation, and then prices break below the consolidation with this momentum move. Prices then consolidate sideways and give this negative bearish wide range bar down, closing right at its low. This bar suggests that there is going to be continuation to this momentum move and that prices are going to head lower. From this point, being in the gap, there's no references of support. So from here, the first reference you have, the first target area you have is the gap fill and this consolidation. So target 1 would be the gap fill, and then target 2 would be down around this consolidation, the pivot low, and target 3 would be this pivot low, and then target 4 would be the next gap fills down over here. But from this point, if I'm entering the position, how to manage it from there, as prices would come down and get slammed with momentum down into this target area, there's, you know, this type of huge wide range bar down into this area. If you give it a little minute, don't just exit, you know, looking at the next bar, it doesn't end any type of inside bar. It's just a topping tail closing right at its low. So this information here is not suggesting that momentum is reversing. Even though you're into a target, a gap fill, a likely area of reversal, this price action does not suggest that prices are going to reverse. So holding on here, bar by bar analysis suggests continue to hold on. As you got this wide range bar up, maybe you are exiting the position because, you know, in the moment when we're looking at things, but if you allow bars to close and don't react during the session of the bar because you never know what's going to happen, the ideal thing to do is always to let a battle take place and let this bar happen, and then you react once the high of that bar is taking out. That, in my experience, is the best thing to do. However, it can be hard in the moment at times. I understand the emotion of your profits, going up and down, and how it can affect the way that we react. But if you are able to hold on after this type of a bar, when you get this type of bar back down again, this should be screaming that you've hit the lottery, that this thing is going to move down with momentum in a big way. And then from that, after that, nothing with bar by bar analysis tells you that you should be exiting the trade. And I don't really hold positions going through the overclose, so this market did gap up significantly, but I personally close out before the end of the day. So that right there would have been a reason for me to exit if I was in this position. I exit positions coming into the close. So with that, we will move it along. Moving averages. The moving average is a simple technical analysis tool that smooths out price data by creating a constantly updated average price. The average is taken over a specific period of time, like 10 days, 20 minutes, 30 weeks, or any period of time the trader chooses. Moving averages are probably the most common technical tool used by money managers and traders today. When the majority of people are using a technical tool, that tool may become effective because of a self-fulfilling prophecy. The markets operate because of supply and demand. If everyone takes action at a certain point, then that point becomes support or resistance because of those traders' action. The 200-period moving average, 50-period moving average, and 20-period moving average are the most common used moving averages. Okay, so this is an example of the moving averages. The blue line, the top one, is a 20-period moving average. The green one is a 50-period moving average, and the red line is a 200-period moving average. And the way that I really use these moving averages, you can see how prices do tend to react at these lines. There are a lot of people out there who are using these, who are taking action as a result of the lines, and they're the most commonly used tool. So that's why I like to use them, to have an idea where other traders are going to react. But also the primary way is it's kind of a guide to make sure that I'm on the right side of the trend. As an example, if we look at how this here starts out, what we'll call like a 3-lane highway, how it really starting to look like a three-lane highway as the moving averages go up. When you have a picture like this with the moving averages all rising like a three-lane highway, the only thing you should be thinking is buy. There is no way shorting should be in your mind at all. This is a very bullish picture. What it means when you have a 20 period above the 50 period and a 50 period above the 200 period is that for the last 20 periods, 50 periods, and 200 periods, the buyers have been dominating the sellers. In that type of environment, you only want to be thinking buy. You don't want to be going against the majority and shorting in an environment where the buyers have been dominating. And that's what this 3-lane highway picture really shows. So when you've got, and also you can see here in examples like this with this breakout pattern. See how, and this breakout pattern here. See how prices went sideways right into the moving average and they broke out right when they hit the moving average. Same thing here, they came in right when they got into the moving averages, that's when prices break out. They then go sideways till the moving averages catch up, and that's when things take off again. So that's really, I use the moving averages very general. I'm not taking action at these moving averages. They really don't mean a lot to me when I'm looking at support or resistance. Price and consolidations and pivot lows and pivot highs, that's everything that I really focused on. It's this moving averages simply are a guide, like I say, to help me. Now in an environment like this where you've got moving averages all over the place, the moving averages really just make my charts sloppy. They do nothing for me. They mean nothing to me. And I'm not using them in an environment like this. The only real times that I'm using the moving averages is when you have that 3-lane highway type picture, which really is just a guide to tell me that this is a very bullish environment. And if, without using the moving average, we should know that it's a bullish environment anyway, just by looking at how price consolidates above support the way that it should. As long as price is stair-stepping higher and above support, then we know it's an uptrend, and that's really what to focus on. But these moving averages can help as a guide to keep you on the right side of things. So same thing here, we get a little downtrend of a 3-lane highway going down in this whole area here, and you can see, the big sell-off that happened. So when you get a 3-lane highway going down, you only want to think about short or selling. You don't want to think about buying in that type of environment. Unless things become extreme, if you get a climactic buy setup, where things become very extended from support or extended from the moving averages, then you could be thinking about going against the moving averages, but only if price becomes very extended away from support, resistance, or those moving averages. Again, another 3-lane highway example, how you can see in this type of environment, when you've got a trend like this, you should only be thinking about buying. But once again, if you just look at the support and resistance areas as we've gone over the entire seminar, you really don't need the moving averages because you can see the support right there to the left. But so if you can do it without moving averages. I choose to do it with moving averages. Doesn't mean you have to. I'm just showing the charts that I use and what I do on a daily basis. It makes things a little prettier for me. I like the way that it looks, so I use them, and that's how I use them. That's about it. So with that, we'll move it along. Multiple time frames. Multiple time frames are used to help see the bigger picture of what's happening. The time frames you use will be determined by what style trader you are. Position trader. Position trading is a mid to long-term style of trading lasting from days, weeks, or months. This style of trading will use weekly, daily, 4-hour, and 60-minute time frames. Day trader. Day trading is a short-term style of trading lasting from minutes to hours. This style of trading will use 4-hour, 60-minute, 15-minute, and 5-minute time frames. Scalp trader. Scalp trading is a short-term style of trading lasting seconds to minutes. This style of trading will use 15-minute, 5-minute, 2-minute, and 1-minute time frames. Okay, this is an example of the time frames that I use. This is my chart layouts that I'm using to take positions, and I primarily am a scalp trader. I do trade all different styles of trading, of scalp, day, and position trading, but this here is a layout for scalp trading. I have a 1-minute time frame, a 2-minute time frame, a 5-minute time frame, and a 15-minute time frame. And primarily I do trade the Qs, but all the tactics that I use can be applied to any security, any instrument that trades. It doesn't matter if it's stocks, currencies, or anything else. It's as long as it moves and you can form these candles, you can trade this method using it. So with that, we'll go over some examples of how I use the multiple time frames to increase my odds for trading. And to look at this is the most current price action that we have. It's got this flag here, so it messes up my charts there. But if I scroll back and take a look, and just go from the top down of how I place positions and how I do it, and how I use these multiple time frames. So here you can see the 15-minute time frame to start on the larger time frame. Really what I'm looking for is I just want to see that the trend is up, or I want to know what the trend is. Now in this example here, the trend is up, and here we have a 3-lane highway on the 15-minute time frame. So that tells me that the longer term picture, the longer term chart is bullish. So in general, I should have a bullish view of things. Again, in this environment, I should never think of shorting. So as I come down, when I look at this picture and I come down to the smaller time frames, all I'm thinking is go long. I'm not thinking about shorting at all. Now to scroll back and to start here on the 15-minute time frame, prices are breaking up above resistance here. They formed a double bottom pattern. Prices break up right through resistance. Prices now pull back to support, right to support where they should. Prices form a breakdown failure. Looks like a 180 reversal. And then this is a range expansion bottoming tail that forms. So very bullish. So we get a lot of bullish price action. Here's a 180 reversal. Here's a bottoming tail bar closing right at its high. So this is all very bullish price action, all suggesting higher. Now at this point here at the 180 reversal, the time on this, I don't know how to get the time, but I can see that the 180 reversal is going to be this pattern here, which on the 5-minute time frame, this is a new low reversal. Here prices take out the previous low. There's a V pivot high. They take out the low with one bar, and prices immediately reverse, coming right back through the breakdown point. So, and this is a potent reversal. Prices then surge higher, making a greater than 100% retracement. Prices then consolidate sideways and give a bullish bar, not closing at its high, but again, this is certainly suggesting higher prices. You should not be thinking lower here at all. Prices pull back. They pull back right to support where they should. They form this bottoming tail. There is a 3-lane highway on this time frame. So the only thing we should be thinking is going long. The 5-minute time frame is tell us go long. So now as I scroll back to that where that period was on the 2 minutes and 1 minute time frames to have a look at what that was. So right here, this is the new low reversal on the 5-minute time frame. This move, which is an ugly move down, is this move right here. And this move down comes down and it takes out the pivot low. Now this looks horrible on the 1-minute time frame. I would not consider buying anything here. I wouldn't consider buying anything in this area, nothing at all here, because of the way that this dropped. Although it looks nice and smooth on the 5-minute time frame. So it's a very nice clean pattern on the 5-minute time frame, but it was really ugly on the 1 minute. So I wouldn't buy anything here. But the pattern did work out. It does then surge with this strong momentum move, blowing right through all these prior pivots that were created. So very bullish price action in a very bullish environment. Now, after this very bullish price action, very bullish retracement against the prior negative move, prices then drop with a range expansion bottoming tail, another bottoming tail, and a powerful reversal again, a potent green bar. Now look at the pattern that happens. We have a sideways tight consolidation. We have a red bar ignored with a little baby bar closing right at its high, which ignites the move. This bar that closes at its high within this consolidation is the perfect entry on the 1-minute time frame. And look at the moving averages here at this point. The moving averages even on the 1 minute are now starting the 3-lane highway. So you see this is an excellent perfect entry where you have all time frames. Sorry, I didn't go over the 2-minute chart, but obviously you'll know here's the 2 minute, here's that move down on the 2 minute, like the 1 minute right here. This is the move on the 2 minute, comes down, takes out the low. It's very ugly, very sloppy move down, but then the surge higher, and then this move down here, this range expansion bottoming tail with this powerful reversal. This is this move here on the 1 minute, and then the sideways consolidation with this, again, even on the 2 minute, bar closing right at its high. So here we have this bar closing at its high. We have this bar closing at its high. The 5-minute time frame, I'm not sure exactly where this is here, over here. So all we can see is that these time frames are very strong, very bullish, all suggesting higher. And then you've got the 2-minute sideways consolidation after this 180 reversal, 1-minute wide range bar up, consolidating in the upper 30% of that wide range bar, tight consolidation, narrow range bars, bar closing at the high or taking out the high. This is the point. It's a beautiful pattern. All time frames in alignment. Then even after that breakout, you get the rally. Then prices pull back for a perfect V pivot. Beautiful V pivot, range expanding right as it drops into support. You get the bottoming tail. Take it. You could go long again right above the high of the bottoming tail. Again, pull back. You get a 180 reversal coming straight up. Another 180 reversal. So here we got a sideways consolidation. So again, this is a pattern that all time frames are in agreement. All time frames are in alignment. Moving averages, 3-lane highway on every single time frame. So in this environment, you should never be thinking short or selling. You should only be thinking about going long. Boom. Bar closes right at its high just prior to the breakout. This is absolutely perfect. You know, all time frames in alignment, bar closing at the high, tight consolidation, narrow range bars. Well, and it fails, but prices come back in. Your stop loss should be underneath the low of the entry bar. And it holds for now, and there it goes, keeps going. So there is one example, and you know, it just keeps going, of those time frames all being in agreement. To continue forward here, looking at this pattern, and there we go. Okay, so here is again, the trend is just to continue with it. You know, we get the gap up. I don't hold positions overnight myself personally. There's nothing wrong with doing it if you have comfort with it. I don't mean to steer you away from it. It can be a very effective strategy for traders. It's just my personality, my style. I generally do not hold positions overnight. I do like to take positions throughout the day. So here we have a large gap up. I would never consider going long after that too quickly after such a large gap up. But look at this sideways consolidation. What happens here is like an extended buy setup where prices drop, take out the pivot lows, and then surge right back up, make a 100% retracement. Prices come down. They come down to retest again. And then they catch up to the moving averages. Now prices have a wide range bar igniting, tight sideways consolidation, breakout bar closing right at its high. And it just takes off. Right, and all time frames are in agreement. Same thing with this nice tight sideways consolidation, sideways base, wide range bar, sideways price action on the upper 30% of the wide range bar, bottoming tail, taking out the highs of the tight consolidation. And then these two time frames again. Here, the only thing I will start to notice on these time frames is that prices are beginning to get extended. There was a gap up and prices are extended. So in this example today, it was a very bullish day. Prices just continued to move higher. They don't always do that, of course. Sometimes they can rally up a bit and then they come back in. So you want to make sure to take note of where these larger time frames are and how extended they are becoming. It's not every day that prices just go and keep screaming and keep going up like this. So today was a very bullish day. They do happen. So let's look at a few more examples. Scroll back, see how far I can go back on the 1 minute time frame, and we'll get back on the what's that? August 21st. Okay, now All right, so we're talking right in here. This is the 15-minute time frame. You can see it's it's choppy. That's this whole choppy move. But you can see even though it's a choppy move, and when things are like this in the smaller time frames, we really don't know which direction things are going to break. Are they going to break up or are they going to break down? But here, when we come to the 15-minute time frame as a barometer of the bigger picture of things, you can see here once again we have a 3-lane highway, moving average, moving average, moving average. Things have just been up. The trend has just been up, and even though there's this whippiness, there is support below. There's no resistance above. So in that environment, in the 15-minute time frame, you should only be thinking about going long. The 5-minute time frame here is that sideways consolidation, that whippy price action all in here. And you can see it was sloppy, but once again, you've got the 3-lane highway. So in this environment, you should really only be thinking that this is not going to go down, that ultimately when things do clean up, it's going to move higher. So with those two larger time frames and the moving averages and this trend intact, take that to the smaller time frames and look for the pattern that suggests going long. So here, there's all this whippy price action. But what I like here is take a look at this move here that rallies up, makes a 100% retracement, blows out all this supply resistance. So prices, that's a signal of strength. Here on the drop, prices could not get below support or even get down to it. That was a bullish retracement. Then they make another bullish rally exceeding the prior resistance points and blowing right through it. Prices drop. They do make a 100% retracement back down, which is negative, but it does create a V pivot high. Prices pull back and they form a breakdown failure. This is a 2-bar consolidation with a range expansion breakdown bar that winds up a bottoming tail, followed by a very powerful reversal up, potent wide range bar. Prices now it looks like a sloppy, a big but wide double bottom. Here's a double bottom pattern. Prices then pull back. They give another range expansion bottoming tail. Very powerful bar right here. These are powerful when they're this big. Coming down to retest. We have 3 retests of this area. There's a general rule of 3, and once you have 3 tests of an area, if it doesn't break after 3, the odds are it's not going to. So here we've had 3 tests. If this was going to break this level and go down, I think it would do it right over in here. It would just be dropping. Where it then rallies and overtakes resistance again. Now look at this momentum strong rally. Then the consolidation that happens is in the upper 30% or upper 50% anyway of this rally. That's a very bullish price action. Now you get this little tail bar closing right up near its high, right near the high of the consolidation. This pattern breaking out right above these highs is an excellent entry on this pattern based on the larger time frames. The 1-minute chart and the 2-minute chart here is you have this is a nice 180 reversal that's happening with a bar closing right at its high. And you can see, look at all throughout the pattern of the 2-minute. There is no other bar that closes at its high until the one that ignites prices out of the consolidation. The very first bar that closed at its high. So there is another example of multiple time frames in agreement. All right, here, so we'll go over one more pattern here. We've got on the 20th. So the 20th is starting here, moving sideways and going up. But looking at the larger time frame, you can see prices had this kind of a climactic buy setup come down to support on this time frame. So that's a bullish area. Prices then have this powerful rally from that point. Momentum move, retracing 100% of the prior decline. So that is a very bullish move and suggesting a change in trend. Prices then consolidate sideways in the upper 30% of that bullish move, and then they break out, and prices now rally greater than 100% of the prior move, now becoming bullish and putting this into an uptrend. Prices rally once again and then pull back right to support, the top of support where they should, and it rallies. So this is very bullish. The 15-minute time frame, you can see here, again, it's been a very bullish environment. It's overall on an uptrend. You get this real negative move down, right to support, and you get a wide range bar right off of that support. Prices rally, they then consolidate a little bit, break out again, and then consolidate a little, break out again, now pull back right to support. Prices then form a little bottoming tail. So this is a bullish buy setup on the 15-minute time frame. So very bullish pattern. The 5-minute time frame had it's this pullback here is right there. The pullback was sloppy, so I wouldn't consider buying it here, but it pulled back right to support. But then you have this 100% retracement blowing right through all the resistance. Then you have a wide range bar down, followed by the inside bar, and potent reversal back up. So from this point here, I'm going to look to the smaller time frame. So this rally right in here, this consolidation, is going to be this point in here, and this point in here. So on the 2-minute time frame, we have, here's the breakdown bar, and inside bar we have a greater than 100% retracement, sideways consolidation in the upper 30% of that bullish move. We have a bar closing right at its high. This time frame at this time suggests going long. This consolidation is on the 1-minute time frame right in here, and you can see here is a bullish 180 reversal with a wide range bar, and you get another little 180 reversal with a bar closing right at its high, just after it broke above the resistance and then consolidated for a second above it, and then gave a bullish bar closing right at its high. So at this point, we've got the 3-lane highway on the 1-minute time frame. We've got the 3-lane highway on a 2-minute time frame, and we have a bullish buy setup on a 15-minute time frame. And we have generally a bullish picture, same thing, on a 5-minute time frame, with the 3-lane highway beginning on the 5-minute time frame. So all time frames in agreement for this entry on this pattern right here. And so from that point, as these time frames get going, any additional patterns that continue to happen, such as the next breakout up here, this beautiful sideways tight consolidation on the 2-minute time frame, is this consolidation here on the 1-minute. And there was no beautiful bar closing at its high or bottoming tail to give it entry, but on this pattern you could either enter breaking above the highs of the consolidation, or finally it did break out and then pull back to give a beautiful a bullish buy setup right here with a void, a V pivot high, followed by, and on the 1-minute chart you can see the decline, the range expanded. You have the widest range bar right at the end, right into support, followed by the reversal. So that's how I use multiple time frames on a daily basis. That's what I use for the intraday charts as a intraday trader. You can switch up the time frames depending on the style trader you are. So if you are a longer term trader, somebody who has to go to work every day, then generally what you're going to be using is a weekly time frame. For your longer term chart, you would use a daily time frame. For the next chart, and a 4-hour time frame and a 60-minute time frame. And on these time frames you would use, just like I use the 1-minute, 2-minute, 5 and 15. We just use the weekly time frame as kind of a longer term barometer, as what's going on, where are prices relative support and resistance on that time frame, what is the trend. So here on the Qs on a weekly, it's a 3-lane highway. It suggests long. There's nothing that says bearish. The only thing I can say is this weekly chart is becoming extended, so taking long positions on a daily time frame at this point, if you were to do so, would have to be done on a short-term basis. You would want to have tight stop losses. So, but all this whole rally here, if you're looking, once we had this nasty drop down, prices came down, took out support. Now prices retrace, and there is a 100% retracement. At this point, it becomes very bullish, and this thing just kept on going. So the weekly time frame certainly suggests higher. If you come to the daily time frame, all these patterns we have on the daily, after the strong retracement up, look at the first pattern that happens. We have sideways consolidation here. Prices break above the consolidation. They pull back for this V pivot high, creating a bullish buy setup right into support with a bar closing right at its high on the daily time frame. So beautiful entry on the daily chart with the weekly in agreement. And if we come, I'm not sure if I can get back there on a date somewhere in May. Yep. All right, and here is our bullish buy setup on the daily right here. This is the 4-hour chart, and the 4-hour chart is very similar. We had this real nice pullback right into support, and prices give a potent bullish reversal. And then on the 60-minute, okay, and that's got to be this move here on the 60-minute time frame in here. So here you can see you get a wide range bar igniting down. Prices drop. The range of the bars narrows as they come into the gap fill. See prices on the 60-minute did react to the gap fill. Just this nice rounding bottom. Then prices gap up, pull back, and just kind of sitting into the support on the on top of the support created from this pivot low. There is a bottoming tail bar closing right at its high, some potent bars. So this time frame, it doesn't give like one of the awesome pictures that I've shown in the seminar, but clearly if you look at all the information, what all these time frames are suggesting, you know, this is a clear turning point. This is in an uptrend. In uptrends, prices pull back, they make higher lows, and then they make higher highs. So at this point where prices are pulled back to a bullish area and they've got this type of pivot low with, look at the potent bars that are within it, the information here certainly suggests that this is a turning point and that prices are going higher from here. So in my view, this is clearly an area where you have a 60-minute time frame, a 4-hour chart, a daily time frame, and a weekly all in agreement suggesting higher prices. Again, here on the daily, you have this bottoming tail. We got prices rally, prices consolidate above support, and you get this nice bottoming tail bar, which the bottoming tail on the daily is likely going to be this move right here. This is a bottoming tail on the daily. That's going to be this move on the 60-minute, on the 4-hour chart. Now, after this move retraces greater than 100%, that's a bullish retracement. From here, you should be thinking the pullback. Prices now pull back. They don't pull back to support. There is no real support here to the left, but it is a bullish retracement. This wide range bar down, it's followed by a couple little bottoming tails, some small consolidation, bar closing right at its high. So how common it is to see these bars that close right at their highs and lows ignite new moves. So this is it is like a bullish buy setup. It's just lacking really an area of support to the left, but it does have the moving averages that are there. So it is a pattern that's, you know, suggesting higher prices. Even from there, though, if you didn't get on at this point, look at what happens as the trend continues. Prices come up and then they pull back and give this gorgeous breakdown failure pattern right in there. That's a picture perfect breakdown failure, and it's the same thing on the 4-hour chart. This beautiful pullback, this is like a new low reversal. Prices poke below the prior low here and bam, give this bottoming tail right off the 50-period moving average, and prices go. And look at the breakdown failure picture that's right here. So these time frames are all, you get the bottom just after the bottoming tail, a couple days later, prices moving higher, all time frames in agreement. And you get the 3-lane highway with moving averages on all time frames. All right, so that's it for moving averages and the multiple time frames and how I use them. And again, this is my chart layout, so we'll move it along. Thank you for watching. Be sure to like our page on Facebook for updates on trade patterns and techniques. Feel free to post questions or comments and I'll be happy to respond and help guide you on your way to trading success.